that we all are eagerly waiting to hear from you, sir, as to the various aspects and intricacies of the Finance Bill 2021. I have not visited frequently Mulund Study Circle, but as far as I understand and the virtues which I have seen in Preeti Savla madam and Srinivas Joshi sir, I can very well understand that you all are really very much concerned about the profession, because the leader which you have selected at WIRC and at Central Council showcases the strength which we all have within us. At the time of COVID, I understand all of our members individually, all of our POUs, program organizing units, have somewhere or the other, financially or in kind, have tried to help society at large and members with their families to face the challenges brought by COVID pandemic. And I would really like to thank each and every member who has really come ahead and took this brethren on his shoulders and shown that chartered accountants can really stand united in problem or in times of adversities. And again, when it comes to exams, as Srinivas Joshi sir will really acknowledge with me that it was really a big task for ICI, and members have really helped us and ensured that all the centers are well equipped with all the facilities so that students can appear for their exams properly. I would like to thank on behalf of ICI to each and every member for being with us in this activity at ICI. There are many initiatives at WIRC. Broadly, I would like to just share with you that all our initiatives, activities, publications, representations are well spoken out in the newsletter, are well listed in newsletter and on the WIRC website. I understand that you all will be abreast about the various announcements in a newsletter and website. And if at all you are not able to go through that, there are many things which have happened in the last 1 year. I would like you to go through that. I am 101% sure that all of our initiatives and activities will be of immense help to each one of you. Just to name a few, as far as publications are concerned, WIRC has really engaged into some of the very apt publications, very thoughtful publications, key audit matters, accounting policies, industry specific publications. I would request you, all those publications are available freely on WIRC website. We have started with help desk because we understood that in time of pandemic, it was really difficult to approach officials at ICI and take up the procedural issues which we are facing at our individual level. Let me share with all of you that virtual help desk plus live help desk is successfully running operationally, and members and students are really taking benefit of the same. I would request all the members that do create awareness and take benefit of the same. One initiative whereby Preeti madam is involved highly into that particular initiative is Khoj. We were of the idea that as far as women empowerment is concerned, somewhere or the other, some of the women are really out of the profession and are now intending to come back to profession. And there is no particular database or no particular place whereby a CA firm who is looking for some resources can really approach them. We are trying to list that on WIRC website without sharing their communication details, whereby any firm all across India, whosoever looks for taking help of such resources, can just click on that function, and the woman member can get a message, and accordingly at her comfort she can communicate with the respective chartered accountant. So this is one of the initiative whereby Preeti madam has really taken a huge effort in bringing this initiative at WIRC. I would request you to give a loud of applause to Preeti madam for taking this initiative. Over and above this, there are many things, but I am not sharing all those things. As far as today's subject is concerned, we are here to deliberate on finance bill and the direct tax provisions. Equity market have given standing ovation to this finance bill. Business community at large have positively accepted the finance bill. We chartered accountants have been covered in some of the provisions, some of the sections. I would just like to put forth, as far as our central council member is there with us, that our profession is gradually moving into a arena whereby we can't be into a protectionist mode and we have to switch over into a dynamic mode. I believe our youngsters are a lot much dynamic, are full of skill sets to imbibe any of the functionalities which is required by the society and the business community. We have to enable them, we have to enable ourselves. We are doing our bit at WRC as far as initiatives are concerned. I believe that we all will really be enriched with that. I am not talking about provisions, but couple of things which I thought so are very welcome in the finance bill is as far as assessments are concerned, the thought process has been changed to from reason to believe to information based assessment. I think so. This is a very welcome step for small assesses. And secondly, for time limit for reopening from 6 years to 3 years, again for small SSCs, I think so this will save a huge time whereby it was invested in unproductive activities, and this will really help the SSCs and we as chartered accountants at large. With this, I am really thankful from bottom of my heart for giving me this opportunity to be with you. I look forward for more and more interaction with you in near future. Thank you. Thank you.
Thank you, sir. And one more announcement of RRC also. So we are having our we are conducting our RRC on 5th, 6th, and 7th of March at Treat Resort, Modi. So the details will be announced very shortly. The paper writers are Keval Shah from GST and Naveen Gandhi on income tax. With this, I request first of all the chairman to felicitate today's speaker. Not much taking time of yours. I request a Peri ma'am to just give a formal vote of thanks to the speaker, to the chairman.
Good evening, friends. Central Council Member C. Srinivas Doshi sir, our Chairman WRC C. Lalit Bajaj, Secretary C. A. Murtuza Kachwala, Convener of Study Circle C. A. Alpesh Doshi, and entire core team, young battalion who are standing at the end and seeing that all the arrangements for this program, study circle meeting is proper. Himanshu, Sneha, Rishi, Disha, Forum, Balaji, galaxy of past conveners who are always available for the team of Mulund Study Circle, and all my dear friends, seniors, ladies and gentlemen, I am really proud of entire team of Study Circle that they have arranged this program after pandemic and maintaining all these things, properly. And during pandemic also, they have seen that regular study circle meetings are happening as required, as scheduled, as per the schedule of due dates. So I request all of you to give a loud applause to this team of conveners. Further, as regards to WRC, I can say, even in pandemic, the highest number of CP hours has been generated. All the credit goes to Chairman Secretary C. Lalit Bajaj and Murtuza Kachwala. Lot of new programs, lot of new initiatives, and the bars of WRC has been raised to the next level. Again, each year it is increasing. So, and all the credit goes to this team of office bearers. Further, friends at ICI also, we are seeing lot of things. So, sir has already updated during last session. We had last week when he has taken the session. So, when I entered the hall, I saw Bhadresh Bhai. Bhadresh Bhai How is the finance bill? ભદ્રેશભાઈ told કે કાંઈ આવ્યું નથી બિલમાં, કાંઈ ટેક્સ રિલેટેડ કાંઈ વધારે છે નહીં. કીધું આટલું બધું છે, માર્કેટ, કેપિટલ માર્કેટ, શેર માર્કેટ આટલી વધી ગઈ, infrastructure, health, everything is so good. This what everyone has hope for the budget is so good. ભદ્રેશભાઈ કહે કે ટેક્સ રિલેટેડ કાંઈ આમાં વધારે છે નહીં. તો આઈ ટોલ્ડ ભદ્રેશભાઈ અમને બીજી કાંઈ ખબર નથી, જ્યાં સુધી મુલુંડ સ્ટડી સર્કલ ભદ્રેશભાઈને સાંભળે નહીં ત્યાં સુધી ખબર પડે નહીં કે ફાઇનાન્સ બિલમાં શું છે. Lot of people, lot of my own members said that what has happened to you? શું થયું? મેં કીધું ઘણા વખતથી સ્ટડી સર્કલ મીટિંગ થઈ નથી, પણ આજે ડેફિનેટલી બધાને ખુશ જોઈને બધાને I am feeling everyone is healthy, happy by seeing the faces of all the members after a long time. Definitely આજે મારું વજન વધી જવાનું છે. So friends, this I have given task of vote of thanks. So I tell you, all both of them have come. Today morning they have gone at somewhere else, in the afternoon they were at WRC office, and again they have to leave for some another meeting which is at Vasai. So in spite of their busy schedule, they have come out over here at Mulund Study Circle, accepting our request. So on behalf of all the members present and Mulund Study Circle, please accept our well-deserved vote of thanks, Lalita and Vitizaka, for coming over here. So now we are eagerly waiting to hear Bhadresh Bhai. Thank you very much, members. Stay safe, stay healthy.
Sir, request, Joshi sir, a request from the chairman to have one word of yours also. One word of from you.
Chairman, is always person in position has to be honored. Today he is a chairman of WRC. He says, I have to go. If you keep on speaking, I'll go. Even if whether you are speaking or I don't bother. But one thing I'll tell you about WRC, every year it is the best region of the country. And every chairman, when he sits in the chair, thinks how I'll be better than the previous chairman. And this chairman also and this secretary who have to work in coordination, they have worked beautifully. I was talking to Nihar Gambosaria sir, who is a vice president who looks after this aspect of how regions are doing. And fortunately for our chairman, Nihar Gambosaria was sitting in WRC for 4 months since he could not go to Delhi because of pandemic, and that's why I think he is highly impressed by our chairman, and we expect the best region prize very soon. Let us congratulate him right now for that we will do the best region. And we always call him Hamara Bajaj. So let us continue that affiliation with him, affection with him, and as a Hamara Bajaj, and also with Murtuza sir. Murtuza sir said that he is not invited here. It's my mistake. Murtuza sir will be invited in next 2 months. Don't worry. He is one of the finest speaker on internal audit. And I will request you, all of you, to attend that. He is extremely well versed in that subject. And once we listen, I have listened to him several times, but that time you'll know. Thank you, both of you, to be with us. Thank you. Thanks a lot.
Thank you, sir. I request core committee member Balaji to give the introductions of the speakers today.
Good evening, friends. It gives me great pleasure to introduce the speaker for the day, CA Bhadresh Doshi. Qualified as a chartered accountant in the year 2011, he has secured merit rank all over India throughout CA examinations, achieved 23rd, 33rd and 11th rank in CA Foundation, Intermediate and CA Final exams. He has cleared paper on principles of international taxation as a part of ADIT course conducted by Chartered Institute of Taxation, UK. He has been practicing as Messrs. Bhadresh, Doshi and Associates since last 17 years. His core areas of practice are litigation matters up to IT-80 levels and consultation on income tax matters, including international taxation. CA Bhadresh Doshi is a chairman of Journal Committee and member of Managing Council of Chamber of Tax Consultants, Mumbai, and a member of Taxation Committee of Bombay Chartered Accountants Society. He is a co-author of Controversy article, which is published every month in BCA journals, and has co-authored a book on Income Declaration Scheme 2016 for BCAS, which he had an occasion to present it to the then Honorable Finance Minister, Mr. Arun Jaitley. He was also a paper writer for BCA's RRC and a co-author of budget publications for BCA's. CA Bhadresh Doshi has taught direct tax to CA final students for last 7 years. He is a co-author of WIRC reference manual. Also, he has written several articles on income tax, which has been published in the CA Journal, Taxman's Journal, and has presented papers on taxation at various forums. With this brief introduction, let us all welcome the speaker for the day, CA Bhadresh Doshi.
Thank you, Balaji. Now I request speaker. Let's take it.
Convener Alpesh, other committee member Himanshu, seniors in the profession, and my friends, good evening to all of you. I never expected that this year I'll have an opportunity to meet you all face to face for this budget analysis. I always had a fear that perhaps I'll have to speak to my screen. Thank God and thank you the organizers of Study Circle for making this arrangement. As a speaker in any virtual meeting is a challenging experience. You are speaking to a screen. There are few audience available in the beginning for 5-10 minutes. Their video is also available. And after 10 or 15 minutes, you see a complete silence. You can't see anybody. You even don't know whether you are speaking to the members, you are speaking to their children, or there is nobody at the other end. This is not for the online viewers today because I know that they are not eligible for CP and therefore they are seriously interested in listening this analysis. So I have about 2 hours left. So as usual, some analysis on the figure works which I did out of this finance bill and related documents. So as we all know, the theme of this budget, this year's budget, is Atmanirbhar Bharat. And the finance minister in her budget speech, she has mentioned that about 29.86 lakh crore worth package were already announced prior to this budget. The first one was in the initial period of lockdown by PM Garib Kalyan Yojana, where 2.76 lakh crores worth relief were given. And then it was followed by a series of announcements which were titled as Atmanirbhar Bharat package. There were 3 different versions of this Atmanirbhar Bharat package. And the total amount of relief which was granted through this particular Atmanirbhar Bharat package were 27.1 lakh crore. So the sum total of these, that has been referred in the speech also, is about 29.87 or roughly 30 lakhs crores worth benefits have been given. So this is the introduction of the budget. And therefore, one can understand that you cannot expect now anything more than this. Whatever was required to be given were already given by way of all these different kinds of relief packages, and therefore you can't expect from the finance minister now in the finance bill to give you any further relief. But I was just wondering that out of this so-called 30 lakh crores of relief package which has been given, I am a tax student and therefore I am always interested as to know that what is there as far as the tax matters are concerned. So I'll just I know it will be difficult to read, but these are the slides which are picked up from the presentation, official presentation on Atmanirbhar Bharat. And I could see only this content getting reflected in the presentation as far as the taxation matters are concerned. And what is the relief given out of this 30 lakhs crores of relief on tax matter is number one, the TDS rates were reduced by 75% for a particular period. And it has been mentioned in the slide that 50,000 crores of benefit have been given by reducing this particular TDS rate for this financial year 2021. As an accountant, I fail to understand that whether this can be considered as a relief or not. Because ultimately we know that it will be resulting into a payment of self-assessment tax liability or an advance tax liability by the deductees. Okay, this is not a permanent benefit which is given. It's just a timing difference for the government, and this year they are not going to realize this particular collection by way of a TDS. But once again, they are going to realize this by way of an advance tax from those deductees. And if the same amount has not been paid by by way of an advance tax by the taxpayers, wherever it is applicable, and I am very sure that out of this, majority of them would be liable to advance tax. There will be only few percentage of the class of this taxpayers will not be liable to advance tax. And therefore, if they are not paying corresponding amount as advance tax, we know that we'll be charged with the interest under section 234C. And therefore, the question really arises as to whether this can be considered as a relief as far as the tax law is concerned. And what all further relief have been given and as far as the tax matters are concerned is nothing but the extension of due dates. I don't want to talk about anything regarding the due date. So these are the figures once again from the official presentation of Atmanirbhar Bharat package. And you'll be surprised to know that out of this 30 lakh crores of relief which has been given, the figure related to tax relief is only 7,800 crores. The first figure on left hand side which you see, which is arising out of several tax announcements which were being done in the initial period of lockdown, and majority of them were pertaining to GST. There was nothing pertaining to income tax. And there's one figure which is of 50,000 crores also which is getting included in this. And therefore, out of 30 lakh crores of benefits which have been given, yeah, we need to appreciate the efforts which have been taken by the government. It is not the case that the relief has not been granted, but as far as the taxation matters are concerned, really speaking, there are no relief which we could see. Nevertheless, if we talk about the total benefits which have already been distributed by way of this different schemes during this lockdown period due to COVID-19, the figure which I was mentioning of 30 lakhs crore is almost equivalent to the size of the total budget which has been presented on the 1st of February. The total size of the budget, as you can see on the slide, is 34.83 lakhs. So roughly around 35 lakhs of crores, out of which 30 lakhs crores of benefits have already been given, or it has been promised that these benefits will be given as part of several different packages which were announced. Now let me come to the tax figures now. So the budget, which is the target which is set for tax collection, direct tax collection, of course, I'm not talking about GST. For the coming financial year, 21-22 is 11 lakh 8,000 crore. You can see the figures on my slide. The first row, the figures appearing in the first row are representing the figures for the financial year 19-20, which is already gone. Initially, when budget was presented for that financial year 19-20, the target was set for 13 lakh 35,000 crore. Then that target had to be revised. This is a usual practice. This is not only happening at our level, this is also happening at government level also. So that target had to be revised. It had to be reduced from 13.35 to 11.70. As against that, the actual collection for 19-20 stood at somewhere around 10.50. So you can see right from 13.35, the initial target which was set, the actual collection was only 10.50. The second row which you see are the figures pertaining to the running financial year 2021. The initial target which was set in budget was 13 lakh 19,000 crore. And of course, thereafter this COVID-19 came and there were lockdown and there were several other difficulties, and therefore that target was drastically reduced to 9.05. And the actual collection so far till probably till January end was only 6.64, 6 lakh 64,000 crores. So the TDS payment for the last 2 months as well as the advanced tax installment, the last advanced tax installment is yet to come. But you can see the difference right from 13.19, the original budget, the original target which was set, the actual collection till today is only 6.64. And considering this points in mind, perhaps the target for next financial year has been reduced already to only 11.08, 11 lakh 8,000 crore. I would like to just mention one more point. The finance minister in her budget speech mentioned that the number of return filers have gone up drastically. And some figures were presented that in year 2014, there were only 3.31 crores of returns were filed. As against this, in 2020, 6.48 crores of returns were filed, almost doubled, almost. It's fine. But I did a further analysis and I realized that this was just a quantity and not a quality. Is why is if you claim that the number of persons filing the returns have increased, that means you have increased the compliance burden on the taxpayers. What we need to look at is whether the tax collection has increased or not. If the tax collection has also doubled up, then yes, it's a qualitative change. And I would just like to present the figures in 2014-15, that same comparison of number of returns which were filed. 2014-15, 6.94, that is 6 lakh 94,000 crores, almost 7 lakh crores. As against this, you can see we are also at the same figure as far as the tax collection of this current year is concerned. Even if you put this year as an exception because COVID-19, you can compare with the tax collection of the preceding year, 1920, where there was no difficulties except for that last 2 weeks. And there the collection was 10 lakh 50,000 crores. So the tax collection has not doubled up. It is only the number of persons who are filing the returns has doubled up. One more statistics which I thought that I was sharing with you is the Vivad Se Viswas scheme, which was announced in the last year. The last date for filing of declaration under Vivad Se Viswas was expiring on 31st of January, and on the 1st of February morning, they announced that we are extending this particular last date to by 1 more month. So it is still open. And 1,10,000 cases so far have already filed this declaration under Vivad Se Viswas, and 85,000 crores of revenue is expected from the persons who have already filed this declaration. So this 85,000 crore, the last date for payment is 31st of March. If you don't pay by 31st of March, and if you defer the payment beyond 31st of March, then additional 10% is required to be paid. And therefore, I believe that majority of this person will be paying this amount by 31st of March. And therefore, this 85,000 crore will be an additional tax revenue for the government as far as this 2021 is concerned. So coming to this theme of budget, Atmanirbhar Bharat, I just want to share some of the unique feature of this particular budget. Prior to the budget, the finance minister announced that this will be the budget coming on a different kind of budget which you have never seen in 100 years before. I was a little scared. So what is going to happen? Then I realized that she is talking about a paperless budget and nothing more than that. Instead of the hard copies of the budget document, the files will be shared. So it was a paperless budget and nothing more than that. And taking a clue from that, we also decided that we'll also not distribute any handout. We'll also just share the PDF copies of the presentation. The another unique feature of this budget is there are no changes in the tax rates. Thank God. It was becoming absolutely difficult to remember the tax rates. And by the time you remember the tax rate, the new year will come. And there will always be a mess up as to which tax rate I need to apply in a particular case. And that really speaking, the tax rates have become too complex over a period of last 2 years. And therefore, thank God that there is no change in the tax rates, and therefore, whatever we have understood and learned will have benefit of one more year to apply. And perhaps that was the reason which I thought that that could be the only reason why the stock markets had given a standing ovation to this budget. Because there was an expectation of increase in the tax rate or levy of another kind of cess like COVID cess. Because cess is something which is, they are fond of, and therefore it was expected, but nevertheless it has not been announced. The another unique feature as far as we are concerned is that in this meeting we don't have any dinner. And that's a true Atmanirbharta. Just jokingly saying. So let's go ahead and let me come to the budget proposals proper. And the first one, which I thought that I should speak about, is a change in the tax audit limit. And this is the apt peak which I could find for this particular proposal. And if you can't read what is there on the slide, she says, "Na khata na bahi, jo hum kahe wohi sahi." So it's an indication where we are moving forward. So coming to that proposal, I'm sure that everybody knows about this proposal, and therefore I did not speak much as far as this particular change in tax audit is concerned. In the last year, the limit for tax audit in case of business was increased to 5 crores, with subject to the condition, of course. And I had deliberated on those conditions also in the last year, and therefore I will not once again discuss about those conditions. Basically, those conditions are about cash transactions. Your cash receipts and cash payments should not be more than 5% of your aggregate receipts and aggregate payments respectively. If any of this condition is not satisfied, in that case, this increase in this threshold limit of turnover for the purpose of tax audit to 5 crore was not applicable. This was introduced in the last year by Finance Act 2020. Now this limit has been increased from 5 crores to 10 crores, effective from running financial year, that means assessment year 21-22, of course. So any SSE carrying on a business whose turnover is not more than 10 crores, and if both of these conditions are satisfied, those taxpayers need not come to us now anymore, and they can file their return without first uploading the tax audit report. However, just to point out that there are no changes as far as section 44 AD is concerned. And therefore, what happens at the ground level is those small SSs having turnover only up to 2 crores, the provisions of section 44 AD is applicable to them. And therefore, they are being made subject to several conditions. Their profit, which they declare out of their business, should be more than 6% or 8% of turnover, depending upon the mode of payment which is received, etc. And if that small businessman is not able to satisfy those conditions, in that case, subject to some more condition, which I'm not going into the detail, is liable to get the books of accounts audited. But now we have another class of person carrying on business having turnover between 2 to 10 crores. In their cases, it is irrespective of the profitability which they are offering. Whether they are offering 6%, whether they are offering 0.6%, or whether they are showing losses, it is irrespective of that. They are not subject to any kind of tax audit requirement, provided they satisfy both of those conditions as far as the cash transactions are concerned. And therefore, don't you think that this particular provision is not fair? You are putting a burden of getting the books of accounts audited on those small businesses having just turnover of 2 crores, and you are not asking the businesses having turnover between 2 to 10 crores to get the books of accounts audited at all. In my view, yes, it is not fair. One more thing here is that as far as this finance bill 2021 is concerned, there are about 95 tax proposals. More than that, little more than that. And I made an analysis of all 95 tax proposal. To my mind, I didn't come across any single tax proposal which is giving benefit to the taxpayers at large in terms of direct gain. I'm not talking about procedural benefits. I'm not on assessments, etc. I am on the tax provisions which is hitting the computation of income or computation of tax liability of the taxpayers at large. There is not a single proposal in this finance bill 2021 which gives direct benefit for computation of income or computation of tax liability to the taxpayer. And when we go along, you will also realize this. There are just a couple of them, like 43 CA, they have increased that threshold band. But all of them were already announced, friends. When that Atmanirbhar Bharat package was announced, this announcements were already made. The press release were already issued. There's nothing new in this. Over and above what had already been announced, what had already been promised, there is not a single tax proposal which gives any direct benefit to the taxpayers at large. And to my mind, 44 AD was a provision which needed an amendment, at least for this year. Due to COVID times, everyone knows that those small taxpayers carrying on a business at a very small scale, not having turnover of more than 2 crores, they are affected like anything. And therefore, during this COVID time, you are expecting the same things from those small businesses, that if you are not able to show your profitability of 6% or 8%, then you need to get your books of accounts audited. At least for 1 year, that is for this year 2021, this particular provisions of 44 AD should have been made inoperative in totality. That irrespective of profitability you are offering, or irrespective of the fact that you are showing losses, you are incurring losses, there is no need of all those procedural conditions. I know I am speaking against the profession, but this is a very fair requirement of the day which should have been addressed in this particular budget, but unfortunately nothing has been done on this. Just to share some of the statistics with you as far as this tax audit is concerned. I know it is very disturbing, but we need to face the hard fact of the life. The total number of tax audit reports which were filed for assessment year 1920 were 28,25,680. Of course, this includes those taxpayers who were subject to file the tax audit report because of the provisions of section 44 AD or ADA. We don't have that bifurcation available in public domain. We have only this total number of tax audit report figures. Out of this, the taxpayers showing turnover of more than rupees 10 crores in that same financial year 18-19 related to assessment year 19-20 were just around 3.5 lakhs. 8 lakh but even if you estimate that out of 28,25,000, if for example 20 lakhs were pertaining to the businesses which were the normal cases not falling under 44 AD, ADA or professionals, then you can understand that out of 20 lakhs, the figure has reduced to just 3.5 lakhs. And this is the benchmark available. One can evaluate its own status as to how many of the clients would not be liable for the tax audit requirements under section 44 AB, and how many of them would be still liable for the requirements of tax audit under section 44 AB. Don't worry, friends. Why complete silence on this? I thought it's 2 minute silence. So we need to have a separate session for this as to what is the way forward for small and medium practitioners. Let me proceed further and let me come to now further set of amendments which are related to the ITR, due dates and filing requirements. I'll just quickly proceed to run the slides, and wherever it is important, I'll deliberate this in detail. So those partners of the firm, in a case where the firm is liable to file a transfer pricing audit report, the date of filing of the ITR by the firm was 30th of November, whereas for the partner that extended time was not available. So that particular difference have now been set right. And those partners of a firm, if firm is liable to file transfer pricing audit report, now the due date for filing of income tax return by the partner will also be 30th of November. Next change in the due date as far as filing of ITR is concerned is on belated return and revised return. If you could not file your return within the due date, today we had a time to file this return up to the end of the relevant assessment year. And if you wanted to revise a return, once again the time was available. Earlier, the time available for revised return was 1 more year after the end of assessment year. Thereafter, it was reduced till the end of assessment year. And now in this Finance Bill 2021, the time limit for both of this, filing of belated return or revised return, the time limit is further reduced by 3 months. So by 31st of December, you will have to decide if there are any errors or omission in the return which you already filed. By 31st of December, you will have to file your revised return. Once 31st of December has gone, that option itself will not be available on the portal to file your revised return. Or if you miss the due date, now 31st of December is the last date. You can't wait till 31st of March for uploading of your return. And friends, these are effective from assessment year 21-22. That's a simple amendment which I wanted to talk about. But friends, let's see what the language is. And you will realize that the language indicates completely a different meaning, the opposite meaning of what I say. Okay. Now I'll put that language in front of you so that you can appreciate what I'm trying to tell you. The amended provision, I have just removed the existing provision and I have just included the amendment in the existing provision so that we can better understand. And let's read it together. The amended provision of subsection 4 of 139, it says that any person who has not furnished a return within the time allowed to him under subsection 1, belated return, may furnish a return for any previous year at any time within 3 months prior to the end of relevant assessment year. Now, what does it mean? It says you have to file this at any time within 3 months prior to the end of relevant assessment year. To my mind, the meaning of, very simple meaning of this English language is that the revised return can now be filed only within 3 months prior to the end of assessment year. That means from 1st of January till 31st of March. You can time period of 3 months. Okay. I hope that the people realize this particular mistake and they set the error right before this finance bill is met as the Finance Act. And therefore, what are the due dates now which are applicable? Well, there are a lot of changes in the due date which have already taken place and which are still taking place. And therefore, I believe we need to have one person in the office to just keep the track of the due dates. And therefore, I thought that let me now summarize what will be the due dates, revised due dates after taking into consideration this amendment. So I'll not repeat every due date, but the point which we need to realize is that in case where the person is liable for audit, either tax audit or audit under any other law, we know that the due date for filing of ITR is 31st of October. If the person is liable to submit the transfer pricing audit report, the due date is 30th of November. Now to both these classes of SSE, I am just with respect to these two classes of SSE. I am not with respect to the general class of SSE where the due date is 31st of July. With respect to these two class of SSEs who are supposed to file their ITR by 31st of October or 30th of November, you are allowing them a time of only 1 month or 2 months max to revise their ITR if there are any errors or omissions. And therefore, the point here is that whether we'll be realizing that there were some errors or omission in the returns which were filed by us on 31st of October or 30th of November just by 31st of December. Within such a shorter period of time, I think it is going to be a very challenging task. Many a times we realize that something has gone wrong in the ITR after we receive the intimation from CPC under section 143(1). And therefore, though you file your return by 31st of October or 30th of November, but still you have not yet received your 143(1) intimation till 31st of December. And you are receiving this intimation post 31st of December. And now because of that intimation which you have received, you realize that there were some errors in the original return which you have filed. Friends, you will not be able to file your revised return at all. And now, if there are any such errors which are adversely affecting the SSC, the only option available is you file rectification under section 154, which is a challenging task. In more than 90% of the cases, they don't accept the rectification request. Or if they don't understand your rectification request, they transfer the rectification rights to the jurisdictional assessing officer. You go there, break your head with him and get the rectification done. So either you go for rectification or you file the appeal just because there were some errors in the return against that intimation which you have received, or you go for revision under section 264. These are the only options which are available. Going ahead, the scope of pre-filled ITR, it has been proposed, it has been mentioned in the budget speech. Though we don't have any amendment to the act, we don't need any amendment to the act because it is not there in the act. This is some additional benefit which have been granted by the portal. It has been mentioned that now your pre-filled ITR which you are going to download from the portal in future will not only include the information of your salary, TDS, etc., but now it will include the information about capital gains from listed securities, dividend income, interest from banks, post office, etc. So a ready-made ITR will be given. I think we are going to become useless even for preparation of ITR. The days will come very soon that the income tax portal itself will give the ready ITR with ready computation and tax liability to the taxpayer. No khata, no bahi. Jo main kahu, wahi sahi. So this is the proposal which has been laid down in the budget speech. I read an interview of Revenue Secretary which was given on leading newspaper Economic Times on just day next to the budget. Revenue Secretary Ajay Bhushan Pandey, and in his interview he further said that we are also going to fill up the GST details in your ITR. If you are aware, in the ITR we have to fill up the profit and loss account and balance sheet. And there in the profit and loss account, there are fields for GST on sales, GST on a purchase, and your GST expenses, etc. So even this figures, there is a proposal that even this figures will be auto captured from your GST data, and it will be pushed to your ITR. And when you download your pre-filled ITR, you will have this data already filled up in your ITR. So you can understand what is going to happen. I need not tell you further. Let me come to intimation under section 143(1). For time limit for issuing this intimation by CPC is already reduced by 3 months in this finance bill. So now the revised time limit is 9 months from the end of the financial year in which you file the return. So earlier it was 1 year after the financial year in which you have filed the return. Now it is only 9 months. So by 31st of December, you will account that you pay this liability. Processing of ITR, the scope of adjustments which CPC can do has been widened. Today we have a provision in 143(1) that CPC, while processing your return, can pick up the information from the tax audit report in your case which has been uploaded. And if the tax auditor has reported any disallowance of expenses in the audit report, these expenses can be automatically taken into consideration for disallowance while processing your return, and your income can be enhanced. The problem with this provision was it was just referring to the words disallowance of expenditure. And therefore, what about if the tax auditor has reported increase in income in the tax audit report? In the tax audit report, we have number of clauses. So for example, any deemed income under section 56 to 10, we have separate clauses of 56. And we have corresponding clauses in the tax audit report also. And all these clauses are referring to the income, not the disallowance of expenditure. There is a difference between these two. If you are reporting 43B clause, you are reporting disallowance of expenditure. But if you are reporting something under the clauses related to 56, that means you are reporting the amount of income to be considered. And therefore, today the problem was that CPC could not take into consideration the increasing income which had been reported by tax auditor in the tax audit report as per the law. What was the practice at CPC level, that I don't know. But now the provision has been amended with retrospective effect, fortunately from 1/4/21, which says that now CPC will be able to take into consideration not only the disallowance of expenditure, but also the adjustments related to increasing income if that has been reported by a tax auditor. One more change in the scope of adjustments. Today, if you read 143(1), you will realize that CPC has right to deny certain deductions if the ITR is not filed within the due date. There are certain deductions which are available only if the ITR is submitted within the due date, not otherwise. And in 143(1), CPC has been given a right, which have been given in my slide in the clause related to present one. So it is only ATIA, IAB, etc. Only those limited sections which were referred. And therefore, in a case where you are eligible for this tax holiday, you have complied with all the provisions, but merely because you did not submit your ITR within the due date, you are not eligible for claiming these deductions. And CPC was correspondingly given a right that while processing the return, while generating the intimation, if they come across that ITR was filed after the due date, there will be an automatic adjustments for disallowance of these deductions. Now the scope is extended, is because technically it is not only these deductions which are not available, but any deductions of Chapter 6A Part C. Friends, I'm specifically referring to Chapter 6A Part C. Therefore, I'm not referring to deductions like ATC, ATD, Mediclaim Premium, etc., etc. I'm talking about only certain tax holiday, income, profit-linked deductions which have been granted under Part C of Chapter 6. None of these deductions are available if the ITR is not filed within the due date, and therefore necessary amendment has been moved for 143(1), allowing power to CPC that it is not only these limited deductions, but any deduction of Chapter 6A Part C, if it has been claimed by the SSC and if the return has not been filed, those deductions should not be granted. This provision is effective from 1st of April 2021. You must be wondering as to why I'm going in so much of details. I realize that in this Finance Bill 2021, there are a lot many amendments. This is the example to begin with. There are a lot many amendments which are setting the current practice right. Today, CPC is already disallowing these deductions. If there is any cooperative society eligible for a deduction under Section 80P, in that case also there is a condition that this cooperative society should have filed the ITR within the due date. Now, if any cooperative society, if you have any case where cooperative society has filed the return after the due date, you will get an intimation from CPC disallowing this deduction under ATP because the society had not submitted this ITR within the due date. But friends, CPC had no power to deny this deduction because CPC had power only to deny the deduction under ATIA, IAB, etc., which doesn't refer to ATP. And now because of the amendment, ATP is now getting referred because all deductions of Part C, Chapter 6A are referred. The point here is that now we have come in an era where the forms, ITR forms and several other forms, or the practice which has been followed by CPC is first deciding as to what should be the law. And then necessary corresponding amendments are being made to the law to set all those things which are already going on at the practice to correct those things. So that is how the system works. This is one example, and going further, I'm going to point out there are many such other provisions which are setting the existing practice as the right one, with prospective effect, with not retrospective effect. Defective ITR, for the first time, they have admitted in the memorandum that this defective ITR is causing problem not only for taxpayers, but causing problem for us also. We have experienced a number of ITR cases. Once you file an ITR, you will be receiving 139(9) notice. In many of the cases, this notice which has been received in an email is going unnoticed, and the return is being regarded as invalid. And when you check the ITR status, because you have not yet received a refund, etc., for any other reason, you will realize that this return has become invalid. It's because defective notice was sent and we did not respond within the time limit. And therefore, to overcome this problem, an amendment has been proposed that the central government will notify by way of a notification that those conditions which are relevant to make the ITR as a valid ITR can be relaxed by way of a notification in required cases. So today we don't have any clarity as to how this particular process will work. But there is a relaxation which has been proposed that all those ITRs which are becoming defective for some small reasons, the proposal is to overcome this particular problem and to notify that these conditions are relaxed as far as this particular class of ITR is concerned. Sending notices to non-filers, we have basically broadly two sets of amendments. One set of amendment dealing with procedure and the other set of amendment dealing with computation of income or tax liability. So I am first taking up those amendments which are related to procedures, and then at a later stage I'll come to other set of amendments dealing with the taxable income or a tax liability. So going forward in the procedure, the amendment with respect to sending notices to non-filer 142.1, if you have not filed the return within the due date, you can be served a notice by the assessing officer. Now there is an amendment which is proposed, which says that it is not only assessing officer, but the prescribed IT authority. So now everything is becoming faceless. And therefore, assessing officer is virtually redundant. Now he is not supposed to do anything. He has no power absolutely. He is just for the namesake, he has been referred as an assessing officer under the act, but now he is not supposed to do anything. It is only system which is going to do everything. And some of the IT authorities will be prescribed, and the signature of that prescribed IT authority will be taken up by the system automatically. He will even not be knowing as to how many notices have been sent. And therefore, the amendment has been proposed that it is not only the assessing officer, but the prescribed IT authority. And therefore, at the central level, there will be some system which will be working and sending all notices in bulk to several taxpayers that you have not yet filed your return and the due date has already expired. So you can expect these notices with effect from 1st of April 2021. Keep a watch on these notices, and what will be the consequences of this, I'm going to point out a little later during the course of the presentation. Now let me come to the set of amendments dealing with the assessment. So far we were discussing about ITR and notices. Now let me come to the interesting amendments related to the assessments. And this is which was reported in the newspaper. The gentleman is CBDT chairman, and he said that now info-based assessments will help reduce harassment of taxpayers. Good, fine. But that indirectly implies that today there is a harassment of taxpayer. And he has publicly admitted this. And he's saying that still there will be harassment, but it will get reduced to some extent. So don't worry about this. So let me come to the assessment procedure. Sending scrutiny notices under section 143(2). We all know that the time limit for selection of your case for the purpose of scrutiny used to wait till 30th of September, and once 30th of September is gone, we could claim that your ITR is being accepted. Now there will be no more scrutiny in your case. So this time limit is reduced. So it is not only that several time limits for the taxpayers are reduced, but even several time limits to conduct a particular procedure for the department is also reduced. So this time limit for sending a scrutiny selection notice under section 143 is also reduced by 3 months, and therefore no notice can be sent with effect from 1/4/2021 beyond 30th of June of the next financial year preceding the financial year in which you have filed the return. And therefore, how this is going to work as far as transition period is concerned. So assessment year 1920, we should have filed the return for assessment year 1920 in the financial year 1920 itself. And therefore, the time limit for selection of those ITRs for scrutiny was, as per the current provision, 30th of September 2020, which has already expired. But we have a new act, which is Taxation and Other Laws, Relaxation and Amendment of Certain Provisions Act 2020, by which several due dates were extended. And one of the due date extended was this. I mean, the due date in general was extended. Any procedure which was required to be done, even including by the IT department, falling due within a period from 20th of March till 31st of December, they were extended to 31st of March 21. And therefore, that time limit which was expiring on 30th of September 20, now it is getting expired on 31st of March 21. So selection of cases for AY 1920 has not yet expired. It is in process, and therefore might be possible that you will receive a scrutiny notice for a particular ITR related to AY 1920. AY 2021 is the 2021 is the financial year in which we have already filed the return, or if it is pending, now we'll be filing the return. And here now the new amendment will apply, and therefore the notice under section 143(2) can be sent for AY 2021 only within 3 months, that is 30th of June 2021. And thereafter, for all further assessment year, this will be the practice. Beyond 30th of June of the next financial year, notices cannot be sent for selection of cases for the purpose of detailed regular scrutiny, what we call, or regular assessment under section 143(3). The time limit for passing of the assessment order is also reduced by 3 months. The current time limit was 12 months from the end of the relevant assessment year, and now that is also reduced by 9 months from the department. So in fact, the job of the department is also very tough, becoming very tough by this. This time limit, change in time limit, is applicable only with respect to the assessment to be carried out under section 143(3) or 144, the regular assessment. I'm not talking about the reassessments, etc., because for those special types of assessment, the special provisions dealing with time limits are applicable. The change is in only regular assessment to be completed. This is also effective from AY 21-22. And therefore, I thought that I'll just summarize the different due dates which are applicable for the department. This is not for us, for the department, for passing of the order. AY 18-19, the scrutiny assessment is going on. Okay, the due date of that was 18 months from the end of the relevant assessment year, and therefore it was expiring on 30th of September. But due to this COVID-19, once again that Relaxation Act amendment extension will apply, and therefore the time limit will expire on 31st of March 2021. AY 19-20, as per the current provision itself, the time limit is 12 months, and therefore the due date for completion of that assessment will also expire on 31st of March 2021. And from 2021, same current provision is applicable. The change of reduction of time limit from 12 months to 9 months is applicable only with effect from AY 21-22, and therefore whenever the assessment of AY 21-22 will be picked up, the time limit for completion of those assessments for AY 21-22 will be 31st of December 22 and not 31st of March 23. Therefore, as you can see, 31st of March 2021 डिपार्टमेंट को बहुत कुछ काम करना है. The sending of notices, if you can see AY 19-20, if you want me to go back to the previous slide, for AY 19-20, the due date for selecting the cases by sending 143(2) notice itself is 31st of March 2021, and the due date to complete the assessment order and pass the assessment order is also 31st of March 2021. So hardly now 2 months have left for the department for selecting those cases and passing of the assessment order related to AY 19-20 by 31st of March 2021. But let me point out that when the Atmanirbhar Bharat package relief was given, those slides which I had shown to you in my initial presentation, there was a specific mention that those assessments which are getting time barred on 31st of March 2021, the time limit for completion of those assessments will be extended by 6 more months, and therefore the revised time limit for completion of those assessments will be 30th of September 2021 will apply. However, it was just an announcement in the press conference which is sitting in the presentation. There is neither a change through that Taxation Relaxation Act nor a change which has come in through Finance Bill 2021. That's the reason why I made a remark that we need a person exclusively dealing with the due dates. You have to keep a track of several acts, ordinance, notifications, circulars, the announcement, press release, and then you have to finally decide as to the due date which I am determining is the correct one or not. So I read the Finance Bill as well as the Taxation Ordinance Act twice to understand whether there is any change with respect to this announcement which was being made. But however, I at least failed to notice that particular change. And therefore, very soon those changes will come. So just to summarize, what is going to happen way forward? On my side, several tasks which are required to be completed by the taxpayer, and on the other side, several tasks which are required then to be completed by the department after you file the return. And if you can notice, everywhere the time limit has now been reduced. Your filing of your belated return, revised return, the last one will be the 31st of December by which you close your revising of return, or if you have not yet filed the return by due date, you need to file your regular return. And after you have done this, immediately in the next financial year, within 3 months, you will get a scrutiny notice. If at all your assessment is required to be done under 143.3, just within 3 months, CPC will process by 31st of December your ITR, and assessing officer will also pass the assessment order by 31st of December within 9 months. And then remaining 3 months, January to March, all your bank accounts will be freezed and attached after passing of the assessment order. It is in order to ensure that the department has sufficient time of 3 months for recovery of tax. All those changes have been done as far as the due date is concerned. Now let me come to a very important part of my presentation, dealing with search assessment and reassessment. This procedure dealing with search assessment and reassessment has been completely changed. I have about 25 slides explaining all these changes with respect to search assessment and reassessment. I don't think that we have sufficient time to deal with all the slides in detail, but I will just summarize as to what all changes which have been proposed. Search assessment, earlier the senior sitting here would recall that we had a system of block assessment. Then thereafter, somewhere in 2003, it was replaced by a new system of assessment, which was a regular assessment, but governed by new provision, that is 153A, 153B, C, and D. What was the procedure? Just to recall, that if the search is taking place today, the assessing officer had power to make the assessment. Not in fact a power, but an obligation to make the assessment for past 6 assessment years, compulsorily, on a mandatory basis. These provisions have now been made inapplicable for any search taking place on or after 1st of April 2021. So no longer that particular procedure which has been provided in the Act in section 153A, 153D will apply with respect to any new search taking place on or after 1st of April 2021. All these changes which have been done in search and reassessment to a great extent is a welcome change. So please don't think that there will be no assessment in case of a search. This provision have been made inapplicable, but now the assessments related to search will be conducted as if it is nothing but a reassessment. And therefore, this procedure for conducting an assessment in case of search has been incorporated in a reassessment procedure. So now we don't see any difference between a reassessment which is taking place in a general case or the assessment which is taking place due to a search. Irrespective of anything, whether there is a search or even in the absence of search, a reopening is required to be done. In that case, the reassessment will be carried out under section 147, and that too as per the amended procedure. That reassessment procedure has also been changed. So now we have a new procedure of dealing with reassessment. All those sections with respect to reassessment, 147, 148, 149, 151, they have been replaced completely. We have a new provision which is 148A, which has been inserted, and all of these are effective from 1st of April 2021. What are the important features of this new scheme of reassessment? The first one, very interesting, is time limit has been reduced. You know that now today reassessment could be done for 6 years, or in some cases, if some of the conditions are satisfied, the reassessment can be done even for 16 years. If there is an income related to foreign assets, all these time limits have now been reduced to 3 years in general case, in some exceptional cases up to 10 years, which I'm going to deal with. The reassessment today, the assessing officer had a complete power if the assessing officer has reason to believe. In that case, assessing officer, subject to completion of some procedure, can reopen your assessment. Those who are dealing with the department must be knowing that a threat which we used to receive from the officer, that पीछे का 6 साल का reopen कर देगा, right? So we were completely at the mercy of the assessing officer as far as the reassessment was concerned. Now, a welcome change in the procedure of reassessment is that it has been completely made information driven, system driven and information based. The assessing officer will act what his system is telling him and not beyond this. If his system is telling him to reopen, he will reopen. If his system is not allowing him to reopen, he cannot reopen. That is how more or less the procedure has been designed. Further, it has been made more transparent with the taxpayer. Today, what was happening is that when you receive notice of reassessment under section 148, you will realize that your assessment has been picked up, has been reopened for the purpose of making an assessment under section 147. And therefore, there is some or the other garbage. Now the change in the procedure is that even before reopening of your case, you will be given a so cause notice. And you will be given an opportunity of being heard. You will be told that, look, in your case, this seems to be an error, or there are this kind of problems are there. And with respect to this, you will be given an opportunity to make your submission. Your submission will be considered, and thereafter, if it is felt that it is an appropriate case to still proceed further for reopening, then only your matter will be reopened. So the taxpayers will have an opportunity to say something even before his assessment is picked up for the purpose of reassessment. Now let me deal with one by one provisions. The primary section 147 more or less is remaining as it is. There is no change as far as this primary provision is concerned. The assessing officer has a power to make that reassessment. The only difference which becomes very apparent is that in the existing provision 147 was referring to reasons to believe. The assessing officer had power to make the reassessment only if he had some reasons to believe. And those reason to believe, there were number of controversies and number of court decisions which are available. Whether this can be said that this particular case, the AO has some reason to believe or not. Now, because this phrase reason to believe was becoming subject matter of controversy, this particular phrase has been completely removed. The AO doesn't need any reason to believe. AO can make a reassessment without any reason to believe. Because as I mentioned to you, now system will trigger the cases. That in this case, the reassessment is required to be done. And therefore, that is the reason why I referred earlier that AOs are virtually become redundant. The system will decide whether this case needs a reopening of the assessment or not. And therefore, this reason to believe phrase has been omitted from the new provision. Some of the slides I'll skip. How the process will work. There's a complete change in the process. The trigger point is that AO need to have some information which will be a system-based information, which I'm going to come to. Thereafter, he will conduct an inquiry, and if required, he will issue a so cause notice to the SSE, as I mentioned, asking the SSE that if you want to submit with respect to your reopening, then you can. And thereafter, a final decision will be taken whether this case needs a reopening of the assessment or not. And if then it decides to proceed further, he will issue a notice of reassessment under 148, and then everything which was applicable as of now will apply. So with respect to each of this, I have a separate slide. I'll deal important points out of this. So what is that trigger point? This is something which is very important. As the CBDT chairman was mentioning, that now all the assessments will be info-based assessment. And there will be a reduction in the harassment of taxpayer. It is true to some extent, because the trigger point for reopening of the assessment now is, as per this provision, that the assessing officer needs to have some information with him which suggests that income chargeable to tax has already escaped the assessment. The tax has not been charged, the tax has not been collected on a particular amount of income in a particular case. Unless he has that information, he cannot proceed for the purpose of reassessment. And that information itself is defined in terms as to what do we mean by this information. And the definition of that information says that it is that information which is flagged in that assessee's case in accordance with the risk management strategy to be formulated by CBDT. So that was where I was referring to. So a risk management strategy will be formulated by CBDT. On that basis, the flag will be put up in those required cases of the assessees for required assessment here. On that basis, there will be a pop-up in the system of the assessing officer, which will suggest him that, look, there is some information in this case and therefore you need to make a reassessment. So just to give you an example, we had faced number of cases where there was a search in the case of the builder and the diary or register was found stating the on money in cash received for sale of flats and properties. So that search assessment was done for the builder, and thereafter the assessments of the buyers were reopened on the basis of that evidence which was found that you have paid some on money in cash for purchasing the property in this particular builder's case. So now what is going to happen is that this information evidences will not move physically. Once that investigation wing has those evidences, perhaps as per this strategy to be formulated by CBDT, they will have to put up this data in their system internally. And once they put up this data in the system, automatically those pop-ups will go in required cases to the respective assessing officers for the purpose of reopening of the assessment. And therefore, the assessing officer individually can't say that, look, I have this piece of paper which is an information and therefore I want to reopen your case. That is not permissible. He need to have an information flowing to him as per the system and not outside the system. So that's something which is a welcome change. And there's another piece of information on the basis of which he can say that I want to reopen your case, and that is a final audit objection of C&AG. So after our assessment, if the internal audit wing of the department had come and there was some audit objection which was raised, so on that basis, yes, it can be considered as an information and the assessing officer can proceed to reopen your case. Today, there were some difficulties for the department because there was some Supreme Court decision which was saying that if it is resulting into a change of opinion or the assessing officer had not applied his mind to the audit objection, then he cannot reopen the assessment. So all those concepts will now change because of this new provision. Going further, altogether, a new section has been inserted, which is 148 capital A, which provides for a detailed procedure. So today we had a Supreme Court decision in the case of GK and Drive Shaft laying down a procedure of reassessment that if as an assessee you can ask for copy of reasons recorded. So we used to write a letter to the assessing officer that please give me a copy of reasons recorded. Then as per his whims and fancies, he used to provide, in some cases he did not provide. Then further, if reasons have been given, you were supposed to, if required, if needed, you could file your objections. If you are filing objection, assessing officer had to deal with your objections, pass a speaking order, whether dropping for the assessment or overruling your objection. That whole of the procedure was as per the Supreme Court decision. And now the corresponding amendments have been made in the Act to incorporate this particular procedure in a more or less in a similar manner. So how this procedure will work, the system of the assessing officer will throw the pop-ups that yes, there is an information in this particular assessor's case and therefore you need to proceed for the purpose of reassessment. In that case, if required, assessing officer on that basis will conduct some inquiry wherever required. If not required, this is not must for the assessing officer, but if required, he will first conduct the inquiry. After conducting the inquiry, then he will have to issue a show cause notice to the SSE, asking SSE to show cause as to why he should not be issued a notice under section 148. So, I'm just repeating. A show cause notice will be given to SSE showing cause as to why a notice should not be issued. So, one notice will be issued to the SSE explaining, asking SSE to explain that why another notice should not be issued, that is 148 notice. Okay, it sounds very funny. A show cause notice will be issued to the SSE requiring him to explain as to why a notice under 148 should not be issued. But howsoever, a show cause notice stage has been given, so SSE has been given an opportunity of being heard. If you want to object that this information is not relevant in my case or whatever reason, he can explain. He can make his submission within a limited time. I'm not just discussing those time limits, and thereafter on that basis the assessing officer will make a decision. He will decide whatever information which he had, whatever inquiry which he conducted, whatever reply you submitted. After considering everything, then he's deciding whether it is a fit case for the purpose of reassessment or not. This slide is not telling us to pass the assessment order, friends. It is only for the deciding whether it is a fit case to make the reassessment or not. The assessing officer will have to pass an order in writings with prior approval of higher authorities. The order, if he is passing that it is a fit case to proceed further for the purpose of reassessment, the copy of this order is also required to be given to the SSE along with a notice under section 148. So in a way, it is making a transparent procedure. Then finally, assessing officer will issue a notice under section 148. So today, the provisions, we were looking at this notice under section 148 for the first time. We were coming to know that a particular assessment has been reopened under section 147 for the first time when in our inbox this notice under section 148 arrives. Now there is a change, whole change in the procedure, and now the SSE will be first given a show cause notice that whether you want to respond, you want to object against your reopening or not. So from issuance of notice under section 148 is a similar provision which we have today. So till now, I was discussing about as to how the new procedure is going to work as far as the reassessment is concerned. And prior to that, I told you that in case of search, that special procedure to conduct the assessment has been done away with, and it has been incorporated in the same scheme of reassessment. So in a similar manner, whatever I discuss, the search cases also, the assessing officer will have to make the reassessment. But however, subject to some exceptions. In case of search cases, and in case of survey cases. So what are those exceptions which will apply one by one? First search case and then survey cases. So the first one in search cases, there are some exceptions which are applicable, and these are very important for us to know. So which all cases will fall in this particular exception is the cases are in the SSS case itself, the search has been initiated 132 or requisition has been made under 132A, or in someone else's case search is conducted, but some assets, jewelry, valuable articles, properties, books, documents, etc. related to your case have been found during the search which has been conducted in someone else's cases. Today we had a provision of 153C to take care of this kind of assesses. So in any of these cases where these things have been conducted, search, etc. has been conducted on or after 1421, this exception will apply. And what is that exception? I told you that for reassessment, the assessing officer will need an information that pop up in a system. Information suggesting that income chargeable to tax has escaped the assessment. So assessing officer will need that information for the purpose of initiation of reassessment. But if there is a search, the assessing officer need not have any information. It will be deemed that the assessing officer has the information, assumed, and therefore assessing officer will have all the power to make your reassessment on a mandatory basis for 3 years, only for 3 years. Today, as per the provision, if the search is taking place, as I mentioned to you, there was a requirement of mandatory assessment of past 6 years that has been reduced by 50%, and now under this provision, irrespective of whether anything is found in search or not, no information is needed, no pop-up in the system is needed, the assessing officer will have to make the reassessment of past 3 assessment years. This is the exception. And the second exception is that whole of that procedure of 148A, sending notice to the SSC ko bulao, ask him to give a reply whether it is a fit case in your case to proceed further for reassessment, etc. is not needed. The assessing officer will directly send a notice under section 148 because the search has taken place in your case. But this exception of not having information is only for 3 years. Beyond 3 years, if you want to reopen the assessment, he will have to have the information. In fact, we need a separate session if we are really interested in knowing the whole of this new procedure in detail. I'm just giving a broad overview of this new procedure and the necessary changes which have been made. The second exception is the survey case. So today, if there is a survey, there is no special procedure of assessment. Either it can be a regular 143 assessment, or past year if needed, it can be a reassessment. Now survey is also specifically referred into this, and some exceptions have been made applicable on a similar line to search, which says that if there is a survey which has taken place in your case, in that case for past 3 years, automatically there will be a reassessment. There is no need that assessing officer should have some information suggesting that some tax has not been charged in your case in some of the income. So moment there is a survey, automatically there will be a reassessment of past 3 years. Now the question which arises over here is that we know that even the TDS wing has been authorized to conduct the survey. And here the provision says that survey under section 133 and TDS survey is also covered under section 133A. So does it mean that if the TDS wing is coming on survey, automatically there will be a reopening of past 3 years? TDS department is supposed to do something else. They are not supposed to look at my income. They are supposed to look at my compliance with TDS and TCS provision. But however, this is the difficulty which is arising. What is the time limit? This is an important one. I'll just discuss this one and then I'll proceed to the next set of amendment. This slide talks about the present position as far as the time limits are concerned. So now 2 types of reassessment procedure have been merged and have been made as one procedure. The first is reassessment, the second one is search assessment. So for reassessment today, The time limit is 4 years in any case, irrespective of anything. It can be reopened up to 6 years, 2 more years, if the escaped income is equal to 1 lakh or more. And it can be reopened up to 16 years if income related to foreign assets is found to have escaped the assessment. So in different exceptions, it is 6 years or 16 years. So you can notice that normal reassessment in normal circumstances, leave aside those foreign assets cases, but in normal circumstances, it could be done for 6 years from the end of the relevant assessment year. If there is a search which has taken place today, as per the current provision, as I mentioned to you, on a mandatory basis for past 6 years, the assessment will be conducted, mandatory. And further, the assessments can be done even up to 10 years, subject to some conditions. And that condition for making an assessment beyond 6 years, if the AO wants to make my assessment for past years, beyond 6 years, in that case, there is a condition that the problem should be of more than or equal to 50 lakhs. It can be for one of the year, for example, for 8th year, some documents have been found suggesting that my income tax has not been paid with respect to my income of 50 lakhs. In that case, you can reopen my assessment under the search assessment provision for that particular year, or for 7 to 10 year taken together. These were the existing limits: assessment, a reassessment, and a search assessment. So it was ranging from 6 years to 16 years, depending upon the exceptions which were applicable. Now, what is the amended provision? In amended provision, as I mentioned to you, we have only one procedure of assessment, that is reassessment. We don't have any search assessment. And the time limit for reassessment is, in normal cases, it is just 3 years. Beyond 3 years, reassessment notice cannot be sent, irrespective of anything else, whether search has taken place, survey has been conducted, irrespective of anything. Beyond 3 years, the assessment now under the amended provision cannot be reopened. If the assessing officer wants to reopen the assessment beyond 3 years, he is allowed to do that up to 10 years, subject to the condition that for any of those years, beyond 3 years and up to 10 years, if for any of that particular year, if the assessing officer wants to reopen your case, the condition is that your escaped income for that particular year should be 50 lakhs or more. If your escaped income was below 50 lakhs for that year, the assessing officer cannot reopen the assessment as per the amended provision. And therefore, the meaning thereby is that beyond 3 years, the problems of the taxpayers with respect to the tax evasion, etc., below 50 lakhs is tolerated. The assessing officer or the department has not been given a power to make the assessment beyond 3 years. If the assessing officer wants to make the assessment beyond 3 years, then that problem should be amounting to 50 lakhs or more for that particular year. And that is not the only condition, friend. It says that if you technically read the provision, it says that the assessing officer should have the evidences which suggest that income chargeable to tax has escaped the assessment amounting to 50 lakhs or more, but that income should be the income which is represented in the form of asset. There is a phrase which is used there, which is already being used under the existing provision of search under 153A and 153C, that escaped income should not be any kind of income. The escaped income should be the one which is represented in the form of the assets. So income should have gone in some kind of assets. If the income has not gone into some kind of assets, then even in that case, the assessing officer will not have any power to make the reassessment beyond 3 years. So there are a lot many things which we can discuss as far as this condition is concerned, but time is not permitting us. As I mentioned to you that we are just trying to have a broad overview of the new assessment procedure. We can have a separate session altogether as far as this new procedure of reassessment is concerned. So we have one more provision with respect to time limit. So what is happening, friends, is that if you see this way, then you will realize that the time limit has been reduced. If you see this slide, you will realize that time limit has been reduced to 3 years. But if you look at other way, the time limit has also been increased. Because today, which was something which was not possible beyond 6 years, is now possible beyond 6 years up to 10 years, even if the search has not taken place. If you see this side in reassessment, the reassessment was not possible beyond 6 years. Okay, except in a case where the income was related to foreign assets. In case of search, yes, it was possible. But now under the new provisions, if you see the time limit, even in a normal case, even if there is no search, the reassessment is possible even beyond 6 years up to 10 years, subject to that threshold of 50 lakhs. So if you see from one way, the time limit has been reduced. If you see from other way, the time limit has been increased from 6 years to 10 years. And therefore, there is a provision to give effect to a transition period. And what that transition period provision says, it says that after these new provisions are becoming applicable, if the notice of reassessment under 148 could not have been issued under the old provision, then today no notice of reassessment could be issued. I hope you understand. And therefore, just to give you an example, for assessment year 2014-15, under the old provision, the time limit was 6 years, assuming that escaped income was 1 lakh or more. And therefore, notice could be issued under 148 only by 31st of March 2021. Now, for example, let's assume that income escaping the assessment for this assessment year 14-15 is, say, for example, 1 crore. AO has the information. Now, after this change in these provisions, after 1/4/21, after the date from which the new provisions are becoming effective, otherwise AO could have issued a notice for AY 14-15, because now the time limit of 10 years will apply because of the fact that the escaped income is more than 1 crore, more than 50 lakhs, which is a threshold. And my example, I give you escaped income amount was 1 crore. And therefore, otherwise, assessing officer could have issued the notice. And therefore, there is a limitation which has been inserted in the new provision saying that no, sorry, as per the existing provision, if you could not issue the notice after 31st of March 21, now under the amended provision, you cannot take a shelter under this relaxation from 6 to 10 years, and now you cannot issue the notice. So that's a welcome restriction which has been placed as far as the power to issue the notice is concerned. And therefore, just to summarize, since we are moving from a larger time limit to a reduced time limit for the purpose of reassessment, what is going to happen for the intervening period? That is something which is very interesting and challenging. And therefore, if you see in this table, AY 13-14, the existing provision was 6 years, the time limit was 6 years, and therefore it was expiring on 31st of March 20. Friends, this time limit I am discussing for issuance of notice under section 148. There is not a time limit for completion of the assessment. And therefore, the time limit was 6 years, and therefore it was expiring on 31st of March 2020. But because of this COVID-19 and because of that relaxation of due date, the revised time limit is 31st of March 2021. For AY 14-15, 6 years, old provision, and therefore for that also the time limit is 31st of March 2021. Now the turn comes of assessment year 15-16, 16-17, and 17-18, 3 years. And this period of 3 years is falling in between under the existing provision and under the new provision. If you apply the existing provision, the time limit of 6 years is applicable. But if you now apply the new provision, the time limit of only 3 years is applicable. Of course, I am assuming here that my escaped income amount is not more than 50 lakhs. If it is more than 50 lakhs, then of course 10 years are available. And therefore, for these 3 years, now the assessing officer will be able to issue notice of reassessment only by 31st of March 2021, because with effect from 1st of April 2021, new provisions are coming into effect. And if new provisions are coming into effect, it will restrict the assessing officer to issue a notice beyond 3 years. And therefore, in any case, if the assessing officer wants to make a reassessment, he will have to issue a notice by 31st of March 2021. And for assessment year 18-19, now it will already be under the new provisions, and therefore only 3 years and 31st of March 2020. And therefore, 31st of March 2021 is a very, very crucial date for the income tax department. 31st of March 2021, friends, is a time limit for completing the assessment for assessment year 18-19, which is ongoing. Is a time limit for selecting your case for scrutiny purpose for assessment year 19-20. Is also a time limit for passing of an order under 143(3) for assessment year 19-20, unless it is extended by 6 months, which I mentioned to you, which was announced in that press release. 31st March 2021 is also a date for picking up the cases and sending reassessment notices for AY 13-14, 14-15, 15-16, 16-17 and 17-18. And therefore, friends, it's my sincere request that you please keep a watch over the inbox, particularly in the last week of March. And I don't know, you will be flooded with so much of notices, unless, of course, all these dates are extended by the income tax department. And as I said, I don't want to talk about anything with respect to the extension of the date. Yeah. Sorry? Assessment नहीं था, but there can be a prosecution, no? टाइम નથી આપતા મને શું કરવું યાર. Okay, there is a mechanism of prior approval, etc. I'm not going into the details of this. Who is that authority who will be giving that prior approval, etc. is available in my slide. If needed, you can go through all this. And now let me come to a faceless thing. So what has already become faceless so far? Till the last year when I spoke here, it was only an assessment, the first appeal before CIT appeal and the penalty. These were the only three proceedings which had become faceless. On 29th of September 2020, during this intervening period after I spoke on the last finance bill, on 29th of September 2020, that act was passed, Taxation and Other Laws, that Relaxation and Amendment of Certain Provisions Act 2020. And if you see that act, you won't believe that around more than 10 to 12 different procedures have already been made faceless under that act. And which are those procedures? Reassessment procedure, faceless. Rectification under section 144. You can't go to the department assessing officer and you can't pursue your rectification matter there. It has become faceless. Revision 263, 264 by CIT, faceless. Transfer pricing officer, determination of arm's length price, faceless. Dispute resolution panel, faceless. 142 inquiry, 142 a special audit, valuation officer reference, faceless. Collection of information for several purposes, faceless. Appeal effect orders, CIT appeals order, ITAT order, High Court, Supreme Court. Assessing officer has to pass an appeal effect order, faceless. Initiation of prosecution, recommendation by the CIT or the assessing officer, faceless. Granting of any approval or registration. So for example, 12AA, ATG approval, faceless. Collection and recovery of tax is also faceless. So a faceless person will be sending an attachment notice to a bank account. You will never know who did this. And therefore, all of these procedures have become faceless. Virtually everything has become faceless. That was the reason why I was putting that remark that assessing officer is now only for the namesake. It is only that, what we say, that NEAC, that it is only that center who is going to do everything. And now there is one more amendment to this. Even now, ITAT appeal proceeding is going to become faceless. Till prior to this, it was only a first appeal. That was only for CIT appeal, it was faceless. We have already started receiving notices from that faceless center for CIT appeal. What they did is on a one fine day morning, they put up the notices in all pending appeal cases. So far, they were slipping. And one fine day morning, because now it is a system based, no, you have to just press a button and all notices will be mailed in all pending cases for appeals. So now even the second appellate authority, which is the highest fact finding authority of our country as far as the tax proceedings are concerned, they also, the appellate proceedings before that authority is going to become faceless. The objective is very good, of course, no doubt about this. And everyone knows what is the objective. I did not speak about that objective at this particular forum. But there is always a side effect for some medicines. And one has to evaluate as to whether those medicines should be taken considering what are the side effects first. Obviously, no, when we go for any particular treatment, we are always concerned about as to what is the side effect of this. And if you see that the side effect is scary, you won't take that medicine. So I'm not that the objective is not good or there are some reservations with respect to this, but one needs to have a balanced approach as to with which objective you are introducing all this faceless procedure and what is going to be a side effect of all this making all this faceless. And the side effect of this is very simple. Today I am standing in front of you and talking to you one to one, and I'm explaining all this proposal of Finance Bill 2021. If from next year, if we start a new procedure, faceless, I'll give my write-up, you read the write-up and understand as to what are the amendments of the Finance Bill 2022. Is that okay? That is already there coming on WhatsApp. There are n number of PDF files getting circulated, but in spite of this, we all are interested in meeting one to one and to understand and raise a question and then further analyze and deliberate as to what are these amendments and how these amendments will apply. It's a simple example which I want to give you. There can be any number of examples. And therefore, the faceless proceedings have its own limitation. Today, we experience that when you make any oral submission, while passing the order, sometimes the authorities miss out that oral submission which you represented before a particular authority. I am not for any particular authority. Let it be first appeal, let it be second appeal, anyone. It can be assessing officer. And you must have also experienced this, that you are making a particular point very specifically during your oral representation before any authority. And when you receive the order, you realize that this particular point has not been considered at all. Now, do you think that when you are going to upload your submission and your evidences, paper book, etc., running into 100, 200, 500 pages, these authorities are going to read all this? I don't think so. Because when you are making your oral submission, they are hearing your oral submission. In spite of this, they have not been considered. Who is going to read all this large submissions which you are supposed to make over the portal running into 100 and 500 pages? So the point here is that the side effect of this is required to be considered first before implementing any of this faceless. Personally, I am not against making any of this procedure faceless, but there has to be some proper mechanism to ensure that the SSEs are properly heard before implementing any faceless procedure. And it should not turn out to be this, that you are making all the faceless procedures, the authorities conducting these faceless procedures are becoming earless. That should not be the end outcome of any of this implementation of faceless procedure. That is the point which I wanted to bring to your notice. Then the next set of amendment dealing with dispute resolution. So now a permanent scheme has been incorporated in the act. Now there's no need of notifying scheme every now and then, something like Vivad Se Vishwas scheme. A permanent scheme is available under the act. If you want to make use of, take benefit of that scheme, you are most welcome. So what is that scheme? A new section 245A is inserted in the act, which says that we are going to constitute DRCs, dispute resolution committees. And once again, all this in faceless manner. No face-to-face interaction with anything, with any of this authority. Now, as far as these income tax proceedings are concerned, it is only High Court and Supreme Court where there is a face-to-face interaction. Except for High Court and Supreme Court, everybody is faceless. So, this faceless committees will be constituted for this purpose. A scheme will be designed, it will be notified in a due course of time. And those persons who are specified in that scheme and satisfying those conditions which are laid down in that scheme are welcome to resolve, settle that dispute by coming before these committees. There are some exceptions to this, which I'm not going into more details of this, but there are some basic conditions which have been laid down in this section itself, that you can resolve your dispute with respect to only a specified order. And what is that specified order? The specified order is the one where the amount of dispute, the amount of variance in the income should not be more than 10 lakhs. So if an addition worth more than 10 lakhs have been made in your order, then you are not eligible for this particular dispute resolution mechanism. So it should be a smaller case. Beyond 10 lakhs, you will have to go as per the normal route of your dispute, that is filing of appeal before CIT appeal, etc. Your returned income should also not be more than 50 lakhs. So if you are declaring income more than 50 lakhs, that means you are high taxpayers, and therefore this particular benefit is not meant for you. Your case should not be of a search, requisition, survey, or information flowing from foreign country through DTAA, etc. So these are all restrictions. Basically, the important point is that it is only in small cases this particular benefit will be available. Your returned income for that year should not be more than 50 lakhs, and the amount of addition made in the assessment order should also not be more than 10 lakhs. If you satisfy this condition, you can approach this particular committee. What the committee is going to do, the committee has been given a power to reduce or waive the penalty, to grant immunity from the prosecution, etc., etc. What will happen to your demand when you are supposed to pay this demand, whether there will be a waiver of interest, whether there will be any concession which will be given with respect to your tax, basic tax liability or not? There is no clarity as far as all of these points are concerned in the law. Perhaps when they come out with a scheme, in the scheme they might provide for some additional benefit, but today as it stands, the benefits are only waiver from penalty and immunity from the prosecution, something like settlement commission. Okay, and settlement commission has been done away with. That is where I am coming to. So what are the other changes with respect to this dispute, alternative dispute resolution mechanism is that today we had a settlement commission. Settlement commission is discontinued forever with one stroke with effect from 1st of February 2021. So now no more settlement before settlement commission. All pending applications will be considered in an appropriate manner, once again in a faceless manner. We had an advance ruling. When I come to advance ruling, I keep on hearing many advance ruling as far as GST is concerned. So we had an advance ruling AAR under income tax, and now this AAR is replaced by BAR. So instead of authority of advance ruling, we will have a board for advance ruling. But what's the change between these two? You may feel that there's only a change in name, but it is not the case. The AAR was required to be constituted where the chairman, etc., of that authority for advance ruling were required to be retired judges. And in the memorandum, it has been said that we are not able to find the appropriate person who can take up this charge. So there is a vacancy. And therefore, we are not able to appoint the retired judges as far as this AAR is concerned. And therefore, we are now recommending replacing of AAR by BAR. So now BAR will be constituted by whom? The Chief Commissioner of Income Tax. So instead of a person coming from judiciary background for deciding the AAR cases, now a person coming from the department itself who is going to decide the advance ruling, if at all, if you are making any application for the purpose of advance ruling. And I did not tell you what will be the outcome of this. You must have also already seen this as far as GST is concerned. Let me come to some of the proposals with respect to TDS. The first one, TDS on purchase of goods. So is a step towards moving towards ease of doing business, or a so-called ease of doing business. I really fail to understand as to why this is required. Last year, they introduced TCS on sale of goods, and now they have proposed to introduce TDS on purchase of goods. It will work in an exactly similar manner. How this is going to work, let's see and understand. This is effective from 1st of July 2021. When as a payer, you are a buyer. We are talking about now TDS, so you are a payer. As a payer, you should be a buyer. And who is a buyer means any person, even individual HF, everybody is covered in this. Provided your preceding year's turnover is more than rupees 10 crores. So if a preceding year's turnover is more than 10 crores, friends, you should never think about ease of doing business. And you should forget about having business in this country. In this case, if you are satisfying this condition and you are becoming a buyer, then what is the obligation upon a buyer? It says that if you are making a payment to a payee who is a resident in India, of course you are making a payment for purchase of goods to a non-resident, this provision is not applicable logically, right? In that case, your payment will be subject to a TDS, provided this payment is of any sum for purchase of any goods. There are a few words which I've highlighted in a different color. I'll just speak about them in the subsequent slide. Provided this TDS requirement will apply if the value of your purchase of goods on a single transaction or in aggregate together for a previous year from a particular person is more than 50 lakhs. And this is required to be seen at PAN level once again, not at GSTN level. So same supplier might be having different location in different states, but you need to apply this threshold of 50 lakhs for a particular pay in totality. And therefore you can't apply this 50 lakhs rupees at the at a particular state level. If these conditions are satisfied, you need to deduct tax at source. When are you supposed to deduct tax at source? Similar provision, payment or credit, whichever is earlier. What is the rate of TDS? 0.1%, provided that supplier, seller is submitting his PAN number or Aadhaar number. If not, then 5%. Because the 206AA is applicable. In the absence of PAN or Aadhaar of the payee, you have to deduct tax at higher rate, which is 10% at present. But for this purpose, that rate has been reduced to 5%. So the rate of TDS will be 0.1% or 5%, whichever is, higher, depending upon whether PAN is submitted or PAN is not submitted. The what is that amount which will be subject to TDS? Beyond 50 lakhs. So first 50 lakhs of purchase of goods, no TDS. Moment you cross that threshold of 50 lakhs, on an amount exceeding 50 lakhs, you need to deduct tax at source. So I am buying goods from a particular person, and till now in a financial year, my total purchases have gone up to 70 lakhs. On first 50 lakhs, I will not deduct tax at source. It is only on balance 20 lakhs, I am supposed to deduct tax at source. There are some exemptions with respect to TDS for deduction of tax at source. And it says that if the TDS is applicable under some other provision, please go under that other provision and don't deduct tax at source under this provision. So this provision is like a residual provision. If none of the other TDS provisions are applicable, you come under this general provision of purchase of goods and deduct TDS at 0.1%. Fine. And it further says that if TCS provision is applicable on that transaction, that means I am purchasing goods from Alpesh. Now TCS provision is applicable in the hands of Alpesh. So what is going to happen? Am I supposed to deduct his tax at source, and whether he is supposed to collect my tax at source on the same transaction? Because I am purchasing goods and therefore new provision is applicable, and he is selling goods to me, and therefore the provision introduced last year 206(1)(h) is also applicable. On same transaction, both of the party will start deducting and collecting tax of the other party. Because government of this country can't collect the taxes from these persons. And therefore, fortunately, there is an exemption which has been provided that if TCS is applicable on the same transaction, then TCS will have a preference over TDS, but not that TCS under 206(c)(1)(h). Am I making these things complicated? Ease of doing business. Please note that it is that person who is carrying on that business, he will have to understand first. So how these two provisions, interplay of these two provisions, TDS and TCS, will work as far as purchase and sale of goods is concerned? Let's try to understand this. TDS and TCS, if buyer is liable for TDS under new provision, 194Q, on same provision, seller is also liable for TCS under new provision 206(1)(h), because his turnover of preceding year is also more than 10 crores. My turnover of preceding year is also more than 10 crores. My purchases from him has already crossed 50 lakhs. His sales to me, of course, my purchase has crossed 50 lakhs, and his sales to me is. And therefore, if TCS is also applicable in the same transaction, seller is liable to collect tax at source, then provision says that both the parties will not apply TDS and TCS on the same transaction. Only buyer will deduct tax at source. Seller is exempted from TCS. Okay, so I hope I'm clear. If it is a purchase and sale of normal goods, I am talking about in this slide, I am talking about only normal goods. There are some exception goods like scrap, like liquor, timber, etc., where some other provisions of TCS are applicable. In this slide, I am talking about TCS only under subsection 1H of 206, which was introduced last year, Finance Act 2020. Provision says if both is applicable, then only TDS should be done, TCS should not be done, provided the buyer has actually deducted tax at source. The exemption from TCS to Alpes is provided I have actually deducted tax at source. Merely because I am liable to deduct tax at source, there is no exemption from TCS to him. He should know, he should call me up and ask me whether you have deducted my tax at source, yes or no, give me in writing because I need a proof, and moment I give him a proof in writing that look, I have already deducted tax at source, perhaps he will not collect tax at source. So what is going to happen at field level is, buyer, if I am a buyer, I'll check applicability of TDS at my level, only at my level. I'm not concerned about who is a seller. So how do I check the applicability of this new provision at my level? Because I'm a buyer, I'm purchasing goods. I'll see what is my turnover of preceding financial year, whether it was more than 10 crores. If yes, I'll see what were my total purchases from a particular person during this year, whether it has crossed 50 lakhs, I'll start deducting tax at source, irrespective of anything else. Forget about seller. At buyer level, it is simple. Now come to a seller level. Seller level, first at his level, he will have to decide the applicability of 2061H. If I am a seller, I'll first see whether my turnover of preceding financial year has crossed 10 crores. If yes, further I'll see whether I have received consideration from a buyer of more than 50 lakhs. If yes, don't start applying TCS. Confirm with the buyer whether on my sale of goods to you, whether you are liable to deduct tax at source under 194Q, yes or no. If yes, whether you have actually deducted tax at source or no. If yes, then I am exempted from TCS. If answer to any of this question, whether you are liable for TDS and whether you have actually deducted or not, if answer of any of these two questions is no, I am supposed to collect tax at source. Now imagine a person having very large volume, turnover running into crores and crores of rupees. Whether that entity, while selling the goods, is going to confirm with each and every buyer that whether you are liable for TDS and whether you have actually deducted tax at source or not. How are you going to implement this particular TDS vis-a-vis TCS practically in a cases where the volume is running into crores and crores of rupees? I don't think it is practicable to apply and implement the provisions in this manner. What the companies are going to do is that, irrespective of what you have done, if I am a buyer, I am going to deduct tax at source, I am a seller, I am going to collect tax at source. Forget about what you are doing. Ultimately, you are going to get a credit of this TDS in your 26 days and it's just 0.1%. Are you not increasing the compliance burden at a mass level just for 0.1% on just purchase and sale of goods, the data of which is already available at transaction level in your GST network? What are you achieving by applying this TDS and TCS? I still don't understand. If at all these provisions were required to be applied, they should have been applied on those purchase and sale of goods where GST is not charged, where the data is not there because the GST, they are either exempt or for some or the other reason they are out of GST, and therefore you are applying this TDS and TCS on those transactions, we can still understand. You want me to make the things further complicated? This is a slide where TDS and TCS both is applicable on same transaction, but this is a case where the goods are of special types. These are not general goods. Special types means scrap, liquor, timber, etc., where the old provision of TCS are applicable. In that case, it says that it is only the seller who is going to collect the TCS. If you are a buyer, you are exempted from TDS. So how many things I need to decide? What is my turnover of last year? What is my purchase or sale of goods during this year? Whether it is cross 50 lakhs or not? What is the type of goods I am buying? Who is the buyer? Whether he is liable for who is the seller? Who is liable for TCS or not? And after deciding, if at all you are capable of understanding this complex structure, in that case, at the end, you will be able to decide whether I am supposed to deduct tax at source, whether I am supposed to collect tax at source or not. And further, one more difference. TDS is applicable on payment or credit, whichever is earlier, and TCS is applicable only on the collection of receipt for consideration of sale of goods from the buyer. And that is also adding further complication to this. So CBDT will issue some guidelines for removing difficulties. In fact, they don't remove the difficulty. If at all there are difficulty, they are resolved in their favor, and that is where the example of the circular is. That the question was raised when the TCS was introduced last year. All these are new development after my budget analysis for the last year. When I discuss about TCS, I had raised all these questions that whether TCS will apply on a consideration including GST or excluding GST, and I took a view that GST should never form part of the consideration for purchase or sale of goods. It is not a consideration for sale of goods. But the question was raised to CBDT, and CBDT removed that difficulty by issuing circular number 17 of 2020, and it said that all types of indirect taxes are required to be included in the consideration when you are applying TCS. And therefore, now the question is this new provision 194Q TDS on purchase of goods, whether it will be on the total amount including GST or an amount excluding GST. That circular was issued only for TCS, not for TDS. TDS is a new provision. But to my mind, whatever they had clarified, they will have to carry it forward. Because for TDS, if they clarify that TDS should be on an amount excluding GST, then they themselves will be in a difficulty. Because earlier they clarified that it should be including GST. However, for TDS, there is an old circular of 17 which had said that if there are services and there is a GST on services component, then TDS should be applied only on the amount before GST and not on amount including GST. But if you read that circular, it is specifically referring GST on services. It doesn't refer to GST on purchase and sale of goods, and therefore it's a difficult task to take a view that whether TDS should be made applicable on an amount including GST or excluding GST. Always on a safer side, a better view is that very recently in the context of TCS, if they have clarified it should be including GST, TDS should also be made applicable on including GST till the time some beneficial clarification is issued. These provisions are effective from 1st of July 20. Yes, please. Yes. Provided my turnover for preceding year was more than 10, his turnover more than 10, value has crossed 50 lakhs, my value has crossed 50 lakhs. Sorry. So I have a second bullet point. I am coming to this. It's not the end. There are so many complications. Correct. Correct. But Rakesh bhai, the problem is that I fully agree with you that GST, that was a view which I took in my last year's analysis, that GST has no income component and therefore there cannot be any TDS or TCS. If some view is taken for TDS, same view should be applicable for TCS. There is no difference in the concept of either TDS or TCS. But the problem, Rakesh bhai, is that if you take that view and department tomorrow clarifies that since for TCS we said including GST and even for TDS including GST, where you will go? That's the difficulty. Threshold of 50 lakhs for the purpose of deciding applicability of my TDS. Just for the first year, I need to consider whole of my transactions with a particular person, even including my transactions for first 3 months, though this is effective from 1st of July 2021. His question is about applicability for a non-resident buyer. So when I am importing goods from outside India, as far as payer is concerned, there is no clarity. But as far as pay is concerned, pay should be a resident. So I am a resident in this country. I am importing goods from out of India. Whether that supplier who is sitting out of India is supposed to deduct my TDS at 0.1% because that person is purchasing goods from me, provided his turnover in the preceding year was more than 10 crores. I think it is going way beyond extraterritorial jurisdiction. So there are a lot of issues with respect to this. A view was taken with respect to some other provisions, for example, 194J, etc., that since there is no restriction on the payer, even non-resident payer is liable for the deduction of tax at source. If you read section 195, there is a specific provision in 195 that one non-resident paying some amount to another non-resident, if that is chargeable to tax in India, even that payer non-resident is supposed to deduct tax at source under section 195. So if for 195 such a view is taken between two non-residents, then here there is a transaction between one non-resident and other person who is resident. But nevertheless, there is no clarity as far as this point is concerned. Might be possible that they might issue a notification clarifying this position, because it doesn't make any sense asking that non-resident supplier to deduct my tax at source at 0.1%. It is creating complications for them. If you rightly understood, friends, if you miss out this particular TDS, it is going to result into a disallowance on that purchase itself, 30% under section 40A1A, because this will also be considered as a TDS default. Whether TDS is applicable on advance payment, yes, because it is on payment or credit, whichever is earlier. This TDS is applicable on purchase of goods. And what do we mean by goods? The question is whether securities, shares, etc. will be considered as goods. This point also I had dealt with in the last year when this TCS on sale of goods was introduced, and thereafter there was a circular which was issued giving some relaxation, and it was clarified that if the securities have been traded over a recognized stock exchange or settled through a recognized clearing corporation, then there is no need of TCS. So extending that same position, perhaps even similar clarification should be issued even for the purpose of new provision of TDS. So meaning thereby, if there is an off-market transaction, if I'm buying if I'm buying shares from you off the market, not over the recognized stock exchange, this will be considered as goods. And provided my purchase value of shares is more than 50 lakhs, perhaps I will have to deduct tax at source at 0.1% under this new provisions. This TDS on purchase of goods is still acceptable. But this new provision 206AB and 206CCA for TDS and TCS respectively is in no circumstances acceptable. What are these provisions? We know that today we have the provisions of 206AA and 206EE as far as TCS is concerned, which says that if the other party has not furnished the PAN number to you, and now PAN and Aadhaar are interchangeable, in that case you deduct TDS at the twice the applicable rate or 10%, whichever is higher. Now it seems that everybody in this country have taken PAN number, and therefore these provisions are not working. But the problem is that those persons who are holding PAN number are not filing their returns. And therefore a new provision, one step further, that you are not only supposed to obtain the PAN number or other number alternatively, but you are also supposed to see that other party to your transaction is filing return under the income tax or not. And that too for last 2 years. If that other party is a non-filer for any of these last 2 previous years, the new provisions will apply. And what this new provision is telling us, you deduct TDS at the twice the applicable rate or 5%, whichever is higher. Should I say something on this? Is this an ease of doing business? How would I come to know that whether the person with whom I am entering into a transaction, whether he is a non-filer of ITR or not, and that too for 2 years? And look at how the complexity of the provisions. Okay, so now let's run through these provisions. So new provisions effective from 1st July 2021, 206AB and 206CCA. They are applicable. Is it 745? I have 150 slides and perhaps I am somewhere in the middle. Sorry. Okay. So we have new provisions. It says that this will be applicable if your deductee or collectee is a specified person. And who is that specified person? The specified person is that person who has not filed his income tax return for 2 immediately preceding assessment years. Okay, for both of this, I mean, for both these years, he should have filed the return. For any of this year, if he is not filing the return, he will become a specified person. And therefore, I have just given you an example. You are applying TDS or TCS on, for example, 1st of December 2021. You need to check whether the other party to your transaction has filed his return for AY 2021 and 21-22 or not. Immediately past 2 assessment years. You are supposed to see this status whether ITR is filed or not filed for those 2 assessment years for which the time limit for filing ITR in his case as per 139(1) is expired. What do you mean by this? It means that I have this slide to explain. It means that if you are entering into a transaction, for example, July 21, so the earliest due date to file return is 31st of July 2021, at least that I know. And therefore, what do I supposed to see is that if since I'm entering into a July 2021, for assessment year 21-22, the due date has not have expired. And therefore, I can't see the status of his ITR filing for AY 21-22. I have to go back to 1920 and 2021 because 21-22 is not the year for which the due date to submit his ITR has expired. And therefore, I need to see whether for 1920 and 2021, whether he has filed his return of income or not. If I am somewhere in middle, August 21 to October 21, and that's the period where a different due date comes. So which 2 years I should see? I should ask him as to what is his due date for a filing of ITR. How would I come to know as to what is his due date? And therefore, which 2 years I should see is a question mark. I don't have any answer to this. If I'm entering into a transaction in a later period, so for example, January 22, then the once again position become clear. Now I'll see the status of his ITR filing for 2021 and 21-22 because for 21-22 now the due date has expired unless, don't speak about extension. 1 minute, 1 minute. So now if you realize your deductee or collectee is a specified person or is not a specified person, this status will keep on changing in between. Did you realize this? It might do you think that I should ask this question to that person? Eventually, I don't know. doing the business. And therefore, what I believe, what is going to happen is this. Today, exactly some kind of similar provision is applicable under 194(10), cash withdrawals from bank account. When we discussed this provision last time, thereafter this provision got amended slightly, and some similar kind of conditions have been imposed on the bank to decide the applicability of rate of TDS, different thresholds depending upon whether that person is a retail filer or a non-filer. And today what is happening is in the portal, the utility has been given. You put the bank number of that person and put your mobile number. And once you do this, a flash message will come on the screen as to which kind of that person is. So for 194, and depending upon return filer or non-filer, rate of 2% and 2% is applicable. So I have just taken the screenshots of the respective persons by taking an example case of one time where return is not filed and one time where return is filed. And therefore, a similar utility will be provided as a total. You put the PAN number of your multi transactions, certain whether it is specified person or not, and accordingly decide the applicability of these two new provisions. I don't think that it is workable to check this for each and every transaction of PTS and PCS at an entity level which has a very large volume. You think that for each and every PTS and PCS transaction, this PAN number, one is to enter the mobile number and then see, and you need to have a screenshot because the change status might change in future. We don't know. And therefore, you need to preserve the screenshot with you to say that you have checked this. But the problem in the screenshot is that you don't have impact on anywhere in the reply. I hope you understand. Okay. You put the PAN number of that party and put your mobile number, OTP will come on mobile number. Once you enter this, you will be just shown the screen without any name, PAN number, nothing. Huh? Date is the system where you can pick up. Yeah, sorry. Huh? Yeah, all types of goods. All types of goods. Sorry? Yes. I think I also missed some of the points here. So, fortunately, here it says that the non-resident won't apply. Okay, so non-resident maybe because it's non-filer in the company, you can't apply this provision. Fortunately, there's a 20. And further, it says that these provisions of PTs are out of this. So, suddenly you can't do a PTs or hire because the employee is not filing ID, that is not needed. So, all these I have given in a slide. You can refer this. The last provision of PTs is adding fuel to fire once again. So, it's a bonanza for senior citizens. It says new section 194P and it says it is applicable only to a specified senior citizen. What is going to happen in this case of specified senior citizen? Who is the specified senior citizen? I am going to explain the subsequent slide. But first, let's understand the mechanism. The specified senior citizen and the specified bank. The specified bank, those banks will be notified for this purpose. So what will happen? The bank will compute the income of the specified senior citizen. The bank will have to understand the income tax act cost, and then compute the income for that specified senior citizen. Compute the tax liability also for that senior citizen. And whatever tax liability bank has computed, the bank is supposed to deduct the whole of the tax liability as TDS while making some payment to that senior citizen. Your bank is that bank who is otherwise supposed to make some payment to the senior citizen, which I will explain in the subsequent slide. So basically, here the provision is that to relax the mandatory return filing requirement in case of a senior citizen. Because you are a senior citizen, this relaxation has been given that you need not submit your idea now. What you do is that you go to bank will compute your income, compute tax liability, total tax liability, bank is going to deduct from the payments which bank is supposed to make to you. Okay, fine. Who is a specified senior citizen? It says that senior citizen should be the one who is resident in India, having age of 75 years or more at any time during the previous years. So now we have another category of senior citizens. We had 60 years, then 80 years, now here for 75 years. Then further, an interesting condition, it says that in order to apply this provision, the senior citizen should have only this income, nothing else. And what is the income? Number one, pension income, and second, interest from that specified bank. ये दो को छोड़ के और कोई income नहीं हो सकता है. If there is any income other than this, then he will be out of this provision. Now, can you consider a case that the senior citizen will be having only these two income, no other income, and this interest should also be from the specified bank. He cannot have an interest, he cannot have a savings bank account in a bank other than the specified bank, and if he is receiving interest from that other savings bank or other bank which is not a specified bank, he will be out of this. And further it says that the senior citizen, how the bank is supposed to know that you are a senior citizen, you are complying with this condition and therefore you are welcome, I will be computing the income and tax. So senior citizen has to submit a specific declaration to the specified bank. Then in that case, if at all you are able to satisfy all the conditions, you are not supposed to file your return. And please note that you are not supposed to file a return. I think when I repeated the sentence second time, you understood this better. So even on a voluntary basis, you can't find the return. It says provisions of section 139(1) will never apply to you. If you look at the other provision where the return filing requirement is relaxed, it says that SSC may not submit his return. Here it says that provisions of section 139(1) will not apply. We have specified bank which I have verified. What are the issues? What is the objective of this? Objective is to simplify the procedure for senior citizen. He is having age of 75 years, is getting pension. Do you think that filing of declaration and dealing with bank will be easier as compared to filing of ITR? You are asking that fellow to go to bank and submit the declaration that I want to ensure this particular benefit. You will say, better I file my ITR rather than dealing with this bank. There is no time to demand for filing declaration. Whether bank is supposed to deduct this strictly on a pro rata basis from every payment of monthly pension payment going to the senior citizen, or how is supposed to deduct in case there is no clarity on this particular point. We have new provision 115 BSC, the last year which was introduced, alternative tax regime. If at all senior citizen who is eligible otherwise want to enjoy the alternative tax regime because it is beneficial, how this is going to work? Because here the provision has been seen the bank to deduct EPS at the rates in force. The rates in force are the normal rate, not those credits which have been given for alternative mechanism under 115 BSC. That means you are denying 115 BSC that senior citizen, you can't know. Now, more important question is that whether that senior citizen will be regarded now as a non-filer of ITR, and therefore the previous provision which I discussed will apply because he is not filing his ITR. We put PAN number of that senior citizen on the portal, definitely the system is going to throw the message that no difference is existing against this PAN number because this fellow is not filing his ITR. And further on the thing, what about the cash flow issue? You are asking the bank to now deduct taxes, so it is always better for senior citizen to pay the whole of the tax liability by the self-assessment tax at the time of filing of return instead of bearing this tax liability spread over the year. He is not supposed to pay the advance tax. There is no question of charging of interest or BMC. We are talking about a senior citizen having only pension income and interest income, no business income. If senior citizen is not having any business income, he is not supposed to pay the advance tax. And therefore, the cash flow is also very low. Why the senior citizens should bear this tax liability on a periodical basis throughout the year? So that's where I stopped as far as the CPS provisions are concerned. Now I come to capital gains. So I have an extension of 30 minutes. So coming to capital gain, now let's talk about only one provision which has been amended. Before I proceed, so far you must have realized that whatever provisions I talked about, except for leaving aside some of the procedural benefit, there is no provision giving any benefit, direct benefits to the taxpayers at mass level. So I keep on repeating this. So now when we talk about the capital gain provision, there is only one amendment dealing with the transactions between partnership and partner. the existing provisions of section 45 subsection 4, what it provides? It provides for taxability of a partnership firm when the partnership firm is transferring its own capital asset to the partner upon dissolution or otherwise. So firm is getting dissolved or one of the partner of the firm is getting retired. And I have this particular capital asset, so firm have handed over, transfer that capital asset to the retiring partner or all the partner upon dissolution. In that case, 45 provides that the transfer partnership firm which transfers capital asset is taxable under capital gains and fair market value of the asset will be considered as full value of consideration. What used to happen under the existing provisions since many years is that if there is a, let me take an example. So if there is a partnership firm, I am a partner with that partnership firm. Today my capital balance in the partnership firm is say for example 10 lakhs. I am getting retired from that partnership firm. As against my capital balance of 10 lakhs, since I am getting retired and some other new partners are getting admitted in the partnership firm, against my capital balance of 10 lakhs, say for example, firm is giving me cash, I mean money, or some other assets in kind worth 50 lakhs. So what is happening in my example is that against my receivable amount of 10 lakhs as capital, I am getting something worth 50 lakhs. There is a gain of 40 lakhs. This gain of 40 lakhs in the hands of the retiring partner, the courts have held that it can't be taxed. Is because 45 was a provision which was providing for taxability of happening in the hands of the transfer of firm, not the partner. Here, 40 lakhs of benefits or worth 40 lakhs has been received by the partner and not by the partnership firm. And therefore, many kinds of tax planning were done under this particular mechanism that against X amount of balance of capital, some additional benefits are being given to the retiring partner. And therefore, in order to overcome this particular non-taxability, new provisions have been provided. And what is the intention? The intention is the same as I discussed. It has been written in memorandum. Now I'm not repeating the whole sentence. This intention is very important to understand the actual application of the amended provision. That was the reason why I brought it in this slide. So now, what are the changes? Instead of 45.4, now we have two new provisions. 45.4 is replaced altogether. And we have another new provision which is 45.4. There is another in my slide, it cannot be subsection 5, it should be 4a. And this 45.4 and 4a both are dealing with the same transaction of making partnership form and a partner. So it is not only form, but it is applicable to AOP or BOA as well. And therefore, this comes under different specified person and specified entity. For the purpose of our understanding, SP, specified person is a partner, and specified entity is a firm. It will also include AOP, BOI, and their members as well. So this is how we are going to apply this SP and SP in the subsequent slide. So two new provisions. The first one, subsection 4. When this will apply, it says that when a partner receives any capital asset at the time of dissolution or reconstitution. Under the earlier provision, the words were dissolution or otherwise. Now here the words are dissolution or reconstitution of that partnership firm. The capital asset which is received by a partner upon this event, it should be the one which represents the balance in his capital account in the books of that partnership firm. And by determining this capital balance, you are not supposed to include any revaluation gain or credit of goodwill, etc. Those notional credits to the capital account should be excluded. So it should be a real capital balance. If this is the case, then further it says what will be the outcome of this if this provision is getting triggered. It says that in that case, profits or gains from receipt of that capital asset by the partner, it will be deemed to be the capital gain in the hands of the firm of that year in which the partner received the asset. Making it complex. The existing provision was much simpler as compared to this. Just to clarify, I have some illustration which I want to take out on the slides. So let me proceed further instead of wasting too much of time. If this capital gain is becoming taxable in the hands of the firm, the manner of computation is also provided. The manner of computation is the similar one which we have today under 45. It says that the FOB of the asset will be considered as full value of consideration and the original cost of the asset will be reduced and the difference is the capital gain in the hands of the partnership firm. more or less similar to what 45.4 which we had today, subject to some differences which I will point out. Then we have another provision 45.4a. Now just see this very carefully. It also says that this provision will apply when a partner receives any money or other asset. 4 was referring to capital asset and 4a is referring to receipt of money or other asset. Once again, from the partnership form, upon dissolution or reconstitution of the partnership form, and this money or other asset which is received by the partner is in excess of capital balance of that particular partner. In that case, once again, the profits or gains of the recipient partner will be considered as capital gain of the partnership firm, and this will be taxed as capital gain of that particular previous year. 45.4, I have some comparison around that. And how do you compute this capital gain under 4A? Is once again total of that money and value of asset minus the capital balance. That difference will be considered as a capital gain. So this is what a snapshot is. If you do not understand this 45.4 and 45.4a, this will be a summarized picture of both of this provision. Both of this provision is provided for taxability in the ends of the partnership firm, not in the ends of the partner. Both of this is providing for taxability for the events like dissolution or reconstitution. The taxability will arise only when partners receive something from the partnership firm. The only difference between these two provisions, if you see, is for the nature of asset. The first one is referring to a capital asset, the other one is referring to money or other asset. And the first one, the correlation between receipt and capital balance is that capital asset received should represent the capital balance. And the second one correlation is that the money and value of assets should be in excess of the capital balance. Under both of this provision, in that case, the capital gain should be taxed in the ends of the partnership form. And there is a mode of computation which is given, which I am not adding further complication as far as this mode of computation is given. This is clear here. Should I proceed with this? As per general provision. So now, the first issue which is rising here is there some confusion with respect to 4 and 4? So that's where the question is. That's the whole issue. So let me give you an example and make it more clear. So first example is that, okay, so this is the example. My capital balance in the books of the firm is 25, and I am retiring, for example. Upon retirement, I have been given some assets by the partnership firm, and the fair market value of the asset is 25. So the asset which I have received is representing the capital balance. My capital balance is also 25. The asset which I received is also worth 25. So whatever I received was representing my capital balance itself, isn't it? And therefore, if I go back to this summary, this 45.4, the first one which is becoming applicable. Partnership firm, I have a partner, I am retiring. On my retirement, I have been given a capital asset. I am not given money. I have been given a capital asset by the firm and the capital asset. And the capital asset which I have received is representing my own capital balance. And therefore 45.4 will apply. If 45.4 will apply, what is the practice? It's simple. It says that FMP of asset minus the cost of asset in the hands of the firm, that difference will be taxed as capital gain. So FMP of asset was 25, the cost of the asset when firm had acquired the asset was 10, and therefore the difference of 15 is becoming my taxable capital gain. Not in the hands of the partner, but in the hands of the partnership firm. That's the first subsection 4 of 45. So then the question is, what is 45.4a? The difference between these two is the important difference. Main difference is in the first one, what I received was representing my own capital balance. In the second one, what I received is something in excess of my capital balance. And therefore, if I continue the same example, if I change the figure, my capital balance was 25, but I have been paid in monetary terms, and I have been given some assets, let's say worth rupees 100. So against 25, my capital balance was only 25, but I have been paid 100 rupees. In that case, 45 4A, it says that upon retirement, you have received money or other asset which is in excess of your capital balance. And therefore, in that case also capital gain will be computed. And if the second provision is applicable, how the capital gain will be computed? 100 I received minus my capital balance 25. 75 is the capital gain. And who is taxable on that capital gain? Is the firm. I received a gain of 75, but I am not taxable. It is the firm which is taxable on this capital gain. This is how 45.4 and 45.4 will apply. This is the best way I can explain. Now there are a number of issues which are arising. Yeah, let me just complete the issue, then I will take up the question. Number of issues which are arising. This is something which is very important one, and therefore I will take 5 more minutes to deal with this in detail. The first issue is how the nature of capital asset and capital gain will be determined, short term or long term. Let me continue with the same example. My capital balance 25, I am retiring, I have been given 100 rupees. 75 is the capital gain, which is taxable in the hands of the partnership firm, but as a short term or long term. What is the period of holding to be seen? I am given the settlement amount to check, not by asset. If I have been given 100 rupees by check, what is the capital asset will be? What is the period of holding of that capital asset? Whether it is short term or long term, who will decide this? No answer. Further, if you see the complication, it says that it is the gain which is arising in the hands of partner receiving this is taxable as capital gain in the hands of the partnership firm. And therefore, gain is the partner who is receiving this. And therefore, period of holding, if at all you want to apply, the period of holding you are going to apply in the hands of the partner to decide whether it is long term or short term capital gain of the firm, or which period of holding they are going to apply. There is no answer to this particular question. The another interesting scenario which is arising is that whether 45.4 and 4A both are mutually exclusive, and therefore either of these two will apply, or in a given transaction both of this can apply simultaneously. This is a highly complex question. This is the highly complex amendment in the whole finance bill 2021 and far-reaching consequences of restructuring of the partnership firm. And if you want to understand this in more detail, I have a few examples for this. So the first example which I already explained. My capital balance 25, I have been given a asset worth 25, not more than that. And therefore, the 45 is applicable. Here we don't have any difficulty at all. And therefore, 45 is applicable. 25 minus cost, 10, 15 rupees of capital gain taxable in the hands of the firm. So let me add the calculation. My capital balance is 25. There was an asset of the firm. The original cost of which was 10. Before I am retired and new partners are getting recruited, these assets is revalued from 10 to 100. And the difference of 90 rupees of revaluation gain has also been credited. My share of this has been credited to my account. And therefore, my capital balance will increase from 25 to 60 because of my share in the revaluation difference of 90. And now I am retiring, and upon my retirement, this asset, which has now been revalued to 100, that asset itself has been given to me upon retirement. Now, how do you apply this amended provision? It is a case where I am receiving an asset which is in excess of my capital balance. And when you apply this provision, you have to see your original real capital balance and not the notionally increased capital balance due to revaluation. So, what was my original real capital balance? 25. What did I receive? Asset. What was the worth of that asset? 100. So I received an asset which is in excess of my capital balance. And therefore, if you go back to those 45, 4 and 4A, if you see the correlation, 45, 4 is applicable if you receive something which represents your capital balance, and 4 is applicable if you receive something which is in excess of your capital balance. So in that example, if you take a view that what I received, asset was 100, my capital balance is 25, so I received something which is in excess of my capital balance, and therefore the statement 45 4 should be met and only that provision should be made applicable. If you take that view, then how the capital gain will be determined, let's see. So in that case, if 4A is applicable, the capital gain is FMV of asset minus my capital balance in the books of the firm, real one. So 100 is the FMV minus 25, 75. Is that difference of capital gain which will become taxable in the hands of the partnership firm under 4A. Now, if this view is taken, you can notice in this example that original difference of 15, which is the difference? The asset is moving from firm to partner. The original cost of the asset in the hands of the firm was 10, and the fair market value of the asset as of today, when it has been handed over to the partner, is 100. The original difference was 90 otherwise. If you apply the existing provision of 45 crore, then whole of the 90 is taxable in the hands of the partnership firm. But now if you apply the amendment provision, and if you take the view that both are mutually exclusive, then it is even better as compared to what you are taxable under the existing provision, which is never the intention of the amendment. Now I'm clear and you're getting this point. And therefore, it's very complex. Let me first fully complete this. And therefore, there can be another view that these two are not mutually exclusive. Both of these will apply simultaneously to the extent they are applicable. And how do you resolve this? Same example, same figure. Just see the results as for another view. So what I did is that I applied 45 crore first. By applying 45 crore, the capital gain of 15 is taxable. FMU of my asset is 100, but it should be representing my balance in the capital account. So my balance in capital account was 25. So you consider the asset only to the extent of 25 minus cost of an asset 10. That difference of 15 can be taxed under 45 crore. And 45 crore continues in the same manner, and 75 is getting taxed under 45 crore. And that is now the whole of the difference of 90 is getting taxed now under 4 and 4A. But this is also not a view which is coming out very clearly from the provisions, because if you read 45.4, it says FMV of asset on the date of receipt is required to be considered as full value of consideration. And therefore, in my example, I am taking only 25. That figure in red is something which is not in accordance with the law. Law says you have to consider full FMV 100. So if you consider full FMV 100 and the 4A, one of the 4A, then it is resulting in double taxes. So whether reduced taxation, logical taxation, or double taxation, there are three views coming from the provision. Which of these views is applicable? There is no clarity on this. There are many more issues which are arising from the one of time. I'm not going into the details of this, but I'm sure that this is going to be a very complex provision. And then consequential amendment is also introduced in section 48, which says that if I'll go back to that slide in order to make it more clear, is this. So in this example, the simple one where the asset of 10 was evaluated at 100. So in my original example, we assume that the asset was given to the partner. Let's assume otherwise. The asset is not given, but only 100 rupees is given in monetary term. Then in that case, it says that, amendment 48, that when in future firm is selling that asset which was revalued from 10 to 100, in that case, whatever is now getting taxed in the spends of the firm under the amendment provision will also be deducted by computing capital gain on subsequent transfer. That's the provision. I think it is becoming too complex, but yeah. So, questions on this? No. Looking for other opportunities. So first of all, the question is how do you compute the year of holding? I was in that question. If you are able to resolve this question, then you come to indexation. Still, you will have to consider the evaluation impact. Yes, yeah. Yeah. And 43B talks about the employer's contribution, and there we have an extended time that you can pay this up to the due date of filing of ITR. But somehow or the other, courts have taken a view that even for employees' contribution, you can apply the provisions of section 43B, and therefore, though it has not been paid by 21st of the next month, if it has been paid on or before the ultimate due date of the filing of ITR, you can always claim this as a deduction. This is how the courts have taken a view, and I have given the list of decisions. There are against decisions as well. It is not that it is uniform view which has been taken by all the courts. But now an amendment has been moved, and rightly so, because that is the position of the law. And the amendment says that now it is very clear that as far as employees' contribution is concerned, it is required to be paid on or before the due date of ESIC or PF. If you miss that due date, then forever this reduction will never be allowed, even if you are paying the subsequently post that particular due date which you had missed. So you can't apply provisions of section 43B as far as employees' contribution is concerned. And this is going to result into a permanent difference now. Once you have missed the due date of your any of the welfare fund, be it ESIC, be it PF, in that case, this particular employee's contribution forever the deduction will be denied. So it will be a permanent difference and not a timing difference. It is going to affect your default tax also. The question is that this is effective from AY 21-22. But they have worded the explanation. These are introduced in the form of explanation, and the explanation says for removal of doubts. And therefore, the question is that whether this amendment will be considered as a retrospective, having retrospective effect, and whether this will apply to the past years or not. It's very, once again, a complex question, but in my view, a view can be taken that no, since specifically it has been inserted with effect from AY 21-22, it should apply only with effect from that year. It cannot be applicable to the past years. I know that many of us have received the intimation from CPC where this disallowance has been made on an automatic basis. If you have disputed this particular intimations by filing an appeal, in spite of this amendment, I would like to take a view that it's a good case to file because even if you consider that this amendment is having a retrospective effect, in spite of this, a view can be taken that when CPC processed my return, there was a debatable view which was prevailing because of the High Court decision. And if the position in the law is not clear, CPC is not having the right to make the adjustment to my total income at that point in time. And therefore, if you need, you can open an assessment and can pass the assessment order, but CPC, that prima facie adjustment by processing the return can't be done. Some of the amendment dealing with real estate, these were already announced prior to this budget through those Atmanirbhar Bharat packages. So the amendment is in 43CA, where the tolerance range has been increased from 10% to 20% only for a limited period and subject to some conditions. So even if the difference between the agreement value and stamp duty value is more than 20%, more than 10%, but up to 20% of your agreement value, in that case, it is not going to affect your computation of business income. What are those conditions which are applicable if anyone wants to apply this benefit is that first of all, it is applicable only under 43C and not in 50C. And therefore, this is applicable to that person who is in the business of this real estate. So this is meant for builders and developers, number one. This is only for a residential unit. So if there is a sale of a commercial property by a builder, in that case, 10% threshold will apply, not 20%. The transfer of that residential property should have taken place only during this limited time period. This 12th of November 20, the date on which this announcement was made, up to 30th of June 2021, it should have been transferred by a first time allotment. So it should not be a resale. A primary sale is only covered of the residential flat. And the consideration, the actual consideration as per agreement of this residential sale of residential unit also should not be more than 2 crores. If all these conditions are satisfied, then business in computation of business income in the hands of the transfer or builder or developer will not be affected. Even the recipient, that means the person who is buying the property from this builder, if all these conditions are satisfied, even the buyer will also not be subject to tax under section 56 to 10 for that difference, even if it exceeds 10%, but if it doesn't exceed 20%. If it exceeds 20%, both these persons are taxable. So this is only for two assessment here, is because there is a condition that the transfer should have taken place only during this particular period from 12th of November up to 30th of June. There are some deductions of
affordable rental projects, etc. I'm not going into the details of this. Yes, some of the deductions and exemptions. The first one is unit-linked insurance plan. The exemption which was available under 1010D in a case where the annual premium is not exceeding 10% of capital sum assured, the exemption has been removed in some cases of units. And what are those cases? So this removal of exemption from 1010D for ULIP will apply if the annual premium with respect to any of your ULIP policy is more than 2,50,000 rupees. This will not apply to non-linked policy. This will apply only to unit-linked policy. So if your annual premium with respect to any policy is more than 250, in that case, that policy is not entitled for any exemption at the time of surrender or maturity. If the person may plan in a manner that I buy 10 different units and I ensure that for each of the unit policy, my annual premium is not more than 250. So to overcome that issue also, there is a provision which says that if you have more than one unit, in that case, only those unit policies will be entitled for exemption where the aggregate of annual premium in any year for all policies taken together is not more than 250. So you can pick and choose. I have 10 policies. I can pick and choose that these 3 policies, my total premium is not more than 250, and therefore I will be claiming exemption with respect to these 3, and the balance I will not be claiming the exemption because this condition is not satisfied. If the exemption is not available, the corresponding taxability provisions have been provided. ULIP has been considered specifically as a capital asset. There is a specific provision in 45 to deal with the capital gain arising. It says that the capital gain will be computed in a manner which will be prescribed by the rules. This surrender, etc. of those ULIP policies has been made subject to STT, and once STT is made applicable, so this has been put at par with the mutual fund, something like equity oriented mutual fund. So even STT will be charged, and once you are charged with STT, that means if exemption is not available, at least your beneficial tax treatment of section 111A or 112A will apply, so you can enjoy those concessional rate of tax. Once again, there are issues. Limitation of time doesn't permit me to deal with these issues. Interest on provident fund. This is something which is very disturbing as far as the industry at large is concerned. So it says that today the blanket exemption has been given with respect to interest income arising from statutory provident fund or a recognized provident fund. And in today's economic time itself has been reported that it has come to a notice that only the topmost PF account holder, HNI, is having a balance of 103 crores. Only one person having a balance of 103 crores in PF. There are top 20 HNIs having a cumulative amount of 825 crores. And top 100 HNIs cumulative investment in PF is 2000 crores. And therefore, it has been reported that undue advantage has been taken of this particular exemption. And therefore, the amendment is meant to provide that now the interest on PF, the exemption will not be available with respect to employees' contribution, SSC's own contribution to the extent it exceeds 2,50,000 in a year. So if my contribution going in my PF account today is 5 lakhs, for 250 interest on 250 contribution, I will be eligible for exemption, but on my contribution in excess of 250, interest which is getting credited on that excess is no longer entitled for exemption. For this purpose, it is only the contribution made after 31st of March 21 is to be considered. So this won't apply to my balance as on 31st of March 21. That will continue to be exempt. It is only my contribution thereafter, after 31st March 21, will be considered for taxability for this purpose. Once again, there are issues which are arising here is that whether that interest will be taxable on a yearly basis or whether it will be taxable only at the time of withdrawal from PA, because the provisions are complex, because we have to see Rule 6 of Schedule 4A, and whether it is taxable as my income from other sources as per general provision or some special provisions will apply. So what we can conclude with respect to this PF is that if you look at the last year's amendment and this year's amendment, this provident fund is on radar of taxability, because last year they introduced one more provision. Just to recapitulate, is that the employer's contribution, if it is more than 7,50,000 in a year, in that case, the employer's contribution itself as well as interest credited on that amount of more than 750,000 will also become taxable perquisite in the hands of the employee. And now interest on employee's contribution for an amount of more than 250,000 is also taxable. Yeah. So that will be coming under the flexibility. You don't have any choice. Whether it is voluntary or mandatory, once the contribution amount exceeds 250,000, the amended provision will apply. It doesn't speak about amount deposited on a voluntary basis. So now better you also contribute, because they are not having fund, you also contribute by your tax on the interest scheme. But that is how the provision is. Okay, leave travel concession LTC. Once again, those press releases were issued during lockdown that because of lockdown you are not able to travel, and therefore your LTC exemption is going best. And therefore a scheme was devised that in lieu of your LTC you will be given a monetary allowance. And this monetary allowance, whether you travel or not, is entirely for exemption, subject to condition that you buy some goods or incur some expenditure which is liable for GST at the rate of 12% or more. And the exemption amount is 36,000 or 1/3 of your expenditure. So 3 times what you are getting, you have to incur as an expenditure. So in order to boost the economy and in order to ensure that these employees start incurring the expenditure for the purpose of enjoying exemption, this particular benefit has been given. Now, employee will have to decide whether I need to incur the expenditure and 1/3 of this I get the exemption, or 1/3 of this I pay as a tax, is something which employee will have to decide. Applicable only for a limited period of 1 year. Startups, yes, similar exemption, those dates which are expiring have been extended. Have trust provisions. So it's a repetitive request for the extension. I'll not be dealing with the trust provisions. Yeah, just a couple of them. Just to clarify, interest under section 234C. If you are getting dividend income, because you can't estimate your dividend income in advance, and therefore you can't pay advance tax on your probable dividend income, and therefore rightly the benefit has been given that if you receive dividend income on a particular date, in that case 234C interest won't be charged for your earlier quarter's advance tax paid year. It is only provided you subsequently then pay the shortfall in your advance tax through subsequent installments of the advance tax. So this is applicable from AY 21-22. 4480A, presumptive taxation. There was an issue that whether this is applicable to LLP or not, because originally when it was introduced, in the memorandum it was said that it will apply only to individual HUF firm but not LLP. But if you read the section, in section nowhere it's specified. In section it was only said any person resident in India. And therefore the question was that whether LLPs were also entitled for this benefit of 4480A or not. Now they brought the amendment with respect to assessment year 21-22 with prospective effect to clarify that LLPs are not eligible for this presumptive taxation under 4480A. But if you see the ITR utility for AY 2021, once you see that LLP, it doesn't allow you to capture your income on a presumptive basis. And therefore, I made a remark in the initial part of my presentation that there are some prevailing practices. In order to bring these prevailing practices on the law, these amendments have been made. So this was already there in the practice. LLP, it was not possible for the LLP to file the return on a presumptive basis. False entry, the amendment which was made by Finance Act 2020 271 AAD. If there is any false entry or omission of entry or books of account, equivalent amount of penalty can be levied under section 271 AAD. Please take this very seriously, because now we have one more amendment supporting this. It says that we are giving power to the officers to make the provisional attachment over the assets of the person who will be liable for this penalty. It's a provisional attachment. Even before completing the penalty proceeding and passing of the penalty order, if the authorities feel that it is necessary in order to protect the interest of the department, because might be possible that person will transfer all these properties. And therefore, in order to ensure that this is not the power has been given that the properties belonging to that person who might be liable for this penalty can be provisionally attached even before completion of the penalty proceedings. So, friends, this were the amendments. The last slide, just few amendments which I listed, which I thought that I will not be able to bring to your notice through this presentation, and therefore, thank you very much. Sorry for exceeding the time allotted. Thank you all the participants and Bhadresh Study Circle for giving me this opportunity to share my analysis. Thank you so much. If you have any questions, now I request Himanshu Bhai to the overtime speakers.
Thanks, Alpesh. Friends, over the year, Bhadresh has become national speaker, speaking at larger forum, but he always kept his commitment to a study circle. Year after year, he accepted our invitation and shared his deep knowledge on the subject. For that, we are always thankful to him, and thank you. Bhadresh, over a year, all the members of study circle also eagerly wait for your speech on this budget proposal. This time also you presented complex budget proposal in easy and simple language. I actually propose vote of time and request everyone to carry the please. Request everyone to write